London with Tom McKenzie.
And here are your top stories. Turning down the heat, US manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after that embarrassing U-turn. Plus, crisis of confidence. Credit Suisse shares recover most of yesterday's losses, despite investor uncertainty over how the bank will pay for its restructuring.
Now, Tom, if you look at the futures, and we saw that late last night, it's actually, we're seeing a recovery in a lot of these equity stocks. There's really an advance after weak U.S. manufacturing data seems to suggest that the Fed maybe not hike as much as expected.
Yeah, and you saw that reflected in the S&P yesterday, the third best start to an October for the S&P 500 since the 1930s. Since 1930, so very strong rally, of course, across Wall Street. Is this because there's a lot of cash on the sidelines? There will be an argument from some that valuations are looking attractive and maybe we're starting to see the bottom. That debate, though, of course, continues, and it's very heated indeed as to where we go from here. Some of the fiscal crisis, some of the concern, the angst around the UK, arguably easing somewhat on the news that the Chancellor will be bringing forward those spending plans. Of course, the RBA coming in with that surprise, a hike less strong than expected. 25 basis points. Many in the markets had expected 50 basis points, a signal maybe of a shift from central banks. To what extent is the RBA the canary in the coal mine? The French CAC currently gaining 1.2%. You're seeing gains here in the UK of 0.7%, 49 points currently. We continue, of course, to look ahead to the Prime Minister's speech on Wednesday, and the Spanish IBEX gaining 1%. Let's switch it over. The jobs market, of course, in the US, still consequential when it comes to the thinking of the Fed. And you have those non-farm payrolls coming out on Friday. There will be a lot of focus on those numbers. Future stateside looking to build on the gains of yesterday. Again, the S&P and NASDAQ closing higher than 2% in the session yesterday. Currently, futures up 1%, the 10-year, and you saw money flowing in, yields down across the curve yesterday, across the Treasury space, 357 on your 10-year, 373. That's a move lower of 16 basis points over in Australia on the back of that surprise move by the RBA, 373 on Aussie 10-year, and the pound at 113, a further gain of 0.4%, Francine.
Tom, when you look at the sectors on the move, you have travel and leisure, but also basic resources really leading the gain. Some 2% higher. Construction banks also leading higher. If you look at the banks, also watch out for Credit Suisse. And then on the downside, but they're still gaining, not by much, but by a little bit. You have, for example, healthcare and food and beverage. So that's a picture overall for some of the sectors, Tom.
Okay, let's get back to the big central banking action of the day then. The Aussie dollar and bond yields have tumbled after the central bank there hiked less than expected. It follows the S&P 500 yesterday, ending its best session since July, as investors paired expectations of just how aggressively the Federal Reserve will hike, following weaker than expected manufacturing data. For more, we are joined by Bloomberg's Christina Kino and Flowbank CIO Esti Dweck. Christine, let's start with you then on the RBA, the surprise in terms of the rate hike, not as aggressive as many had expected. Does it signal now that the central banks are ready to pivot?
Well, Tom, I think, yeah, it is quite an interesting move from the RBA, being one of the bellwethers of global policy making. And Australia, of course, in a very interesting position. It's a smaller open economy. It's very much exposed to what's happening globally, but also what's happening regionally, given that China is its biggest trading partner. And so the fact that we're seeing this sort of move from the RBA now really speaks to the challenge that a lot of central banks are facing across the globe, right? This balance between growth and inflation, on the one hand having to tackle inflation, but then also minding the growth impact of such a rapid and massive increase in interest rates. And I think what we're seeing from the RBA now, it's going to be interesting if other central banks follow the same route. I mean, we're already seeing signs of a pullback in rate expectations for the Fed. Of course, we're seeing terminal rate pricing for the Fed a little bit lower this week than where we were last week. And of course, we're seeing something similar from the UK after the UK government's U-turn on its fiscal policy. So in a way, it is quite interesting to see Australia setting the example here.
Yeah, and on that example, Esther, how vulnerable are bonds actually if we don't see a pivot from the Fed to what the RBA did?
You know, I think we are starting to hear scatterings of slightly more dovish rhetoric from the Fed, acknowledging that they have to see a little bit of an impact of all the hikes that they've already done, that there is liquidity concerns globally, volatility, of course, that rose a lot. I don't think we're going to get any kind of pivot. Do we get closer to a shift downwards in the rate hikes and maybe closer to a pause at this higher for longer? I think that is becoming a bit more likely, but we're going to need to see a lot more data showing that we're having some cracks in the labor market, some cracks in the housing market, before you really have a Fed that can acknowledge that it might pause. They really don't want to take their foot off the pedal and risk inflation expectations coming back higher.
Esty, where do you stand on this debate then? The rally that we saw yesterday, Deutsche Bank saying they're fairly bullish. This could be setting up for a significant rally towards the end of the year. Bank of America, though, saying that positions have not yet been fully washed out. Where do you stand on this debate?
I have to be closer to the first version. It feels like we've been a lot closer to capitulation. It does feel that disinflation and, again, some of these cracks in the growth picture are starting to appear. Disinflation more and more widespread across a lot of data points. And over the next couple of months, we've already priced in a pretty negative or disappointing earnings season. We know we're going to get a few more of those announcements, but so much of that has started to be priced in September. I do think that we should have a nice bounce into the end of the year.
Christine, what do you think will continue supporting some of these equities that we're seeing in Europe?
Well, Francina, I think I agree with Esty. You know, I think there's a lot of sentiment now trying to find the bargains, and there's a lot of that here in Europe, of course, being the land of value. It is quite interesting, though, because we are seeing, again, this debate, right, whether equities have bottomed at this point or whether it requires more capitulation in the markets. I think Esty is correct to highlight the earnings seasons that are upcoming, because that would be crucial to kind of gauging where sentiment really is. One of the things, of course, that we've been watching for is really that downgrade in future earnings expectations, because we have seen kind of the frontline sentiment in equities really getting downgraded, but not necessarily being followed by that downgrade in future earnings expectations. So I think that would be interesting. If we see that in upcoming earnings seasons for the rest of the year, that could be quite an important signal for where the market is about to bottom.
And Esty, we've seen concerns flagged from the likes of Nike and others around inventory build-up, the likes of Meta cutting headcount for the first time since that company was formed. When you look ahead to the earnings season, do you expect to see downgrades, or will these earnings hold up?
I think we're going to see a mix. We're certainly going to get downgrades, and in a way, that bad news is something of good news for the Fed, because it is showing that things are cooling. At the same time, depending on if it's too consumer-led or not, we're going to have to see a bit of the market reaction. As you said, Nike definitely worried investors. On the other hand, I think especially in the tech sector, some of the earnings are going to hold up as they have quarter and quarter throughout the pandemic and since, especially across some of the big tech. And I think that's going to help move the market higher later in the year, because those earnings will probably be more robust than what people expect. We've heard some of the cost cutting already from some of these big names. So some of that has been sort of preempted already in the price. But I think in the earnings, they do tend to surprise on the upside.
Christine, when you look at some of the big names overall, we don't tend to talk about China as much as we used to in the past. Is there something, when you look at OPEC, and this is maybe a warning sign, a warning shot across the boat, that we don't 100% understand why they want to cut by 1 million barrels of oil a day unless they see something very ugly? Could that very ugly be coming from the east?
Potentially, Francine, especially because, all throughout the year, China, in the state of demand, in the world's second biggest economy, really has been quite the wild card for a lot of markets this year. And so it is quite ominous that the OPEC Plus group is seeing this need to cut production, potentially pushing the price of oil ever higher again in an inflationary environment. I mean, there's not a lot of visibility at the moment in terms of where the China story is going to go. We know, of course, that there's a lot of interest from authorities there to still support the economy. They haven't quite bounced back fully from the post-pandemic era, since they're still kind of grappling with the aftermath of all of these constant lockdowns. And so it is, I think, I would expect China to continue just being a bit of a wild card here for a lot of expectations in the macro land, and potentially something that could be a bit of a downside threat heading into the fourth quarter.
Esty, on the UK, we had the U-turn, of course, yesterday from the Chancellor. Then we hear and we have reporting that, in fact, they're going to bring forward their spending plans, that maybe you'll get the OBR with their analysis and their checks as well. Does that reassure you?
It's been something of a mess, and it did break a little bit of the confidence in the markets. The U-turn was seen as a positive, but of course, the fact that there needed to be a U-turn wasn't great. So I think you still have to be a little bit cautious on the UK. A lot of uncertainty. We don't really know where we're going to end up with this mini budget and with the news. If the OBR numbers show and that spending is being reined in, that would definitely be a big boost. And maybe now that they've scrapped that higher tax earners tax cut, that could help as well. But I think the confidence side, especially on sterling, is going to take a lot more time to recover.
So does that mean you're expecting the government to do more U-turns to help sterling, or is it just a loss of credibility that will take time to rebuild?
I think it's probably more in terms of credibility is a strong word, but at least confidence and some worry about the future path of the UK. So it will take time for sterling to recover. We've had a bit of, Liz Truss has had a little bit of an issue with this view that she's a chameleon and that she changes her mind a lot. So one U-turn already less than a month into the premiership isn't fantastic. I think she's going to do everything she can to avoid more U-turns and this perspective, this view that really she just flip-flops. So at this point, not expecting a lot more U-turns, no.
All right, so no U-turns. Or one of my favorite headlines is, a trust credibility problem. Bloomberg's Christina Keenan to Esty Dweck, Flowbank Chief Investment Officer. I can't remember the headline, but it was a very good one. And also we need to look at Greg's, because breaking
Love
news.
Greg's.
I know. This is
Big
why
fan
I'm
of
bringing it
Greg's
up.
and other sandwich shops, of course.
The vegan sausage roll.
Yeah, the vegan sausage roll.
Controversial.
They have fantastic service. They have good prices. The stock is up about 6% on the back of some pretty decent earnings after that. The high street favorite that is Greg's,
Yeah,
the white bread sandwich maker.
For some. Coming up, Credit Suisse plunging into fresh market turmoil
Not for the
as the
classic
bank's
Francine.
chief executive fails to calm markets. We'll discuss the Swiss lender's future next. I'm just a bit too European for Greg's.
You are. You've got too much class
I'm
for
more
Greg's.
of a Carluccio. No, it's not that.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm
Right.
trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. We're 14 minutes into European trading day. And look at that, we're seeing gains across the board. We saw also U.S. equity futures extending some of the advances they started yesterday. There was some weak data, weak U.S. manufacturing, and of course that's dampening bets on the Fed's hawkishness. So Tom, quite a lot going on. And then we also look at the individual movers.
Yeah, some optimism in these markets. That's been reflected in some of the individual movers as well. Porsche, of course, they listed over in Frankfurt. They listed last week. They ended the session yesterday below their IPO price of 82.50. They're now.
Tom just throws it in like that, but he covered the Porsche IPO.
I love this story. I love this story.
It's
It's
a
on the
good
ground. It's a
story.
fantastic. Look, they're just above their IPO price, 82.58, just a skim above that level, because they reported an update in terms of sales out of the US. Importantly, they are saying that supply is improving and they have solid demand. So the stock they're gaining 1%. Berkeley Group, we pulled this one out for you, just a gain of 0.8% on the reassurance, maybe with a chance of pulling forward those fiscal plans. Does that do much? Yes, the front end of the gilt market is coming off a bit. Maybe that leads to a slight readjustment in terms of mortgages, but of course the property market is central to what is happening in the gilt market. And then Credit Suisse, we cannot take our eyes off this company after the rout of yesterday before it paired those heavy losses, currently getting 3.7%. That debate amongst analysts as to what happens with restructuring plans, Francine, and to what extent they're going to have to sell off assets, how they're going to pay for that restructuring scheme. Let's get more on this then with JP Barnett. JP, let's bring you in at this point. How serious then is the danger to Credit Suisse?
Good morning. I would say it's very serious. Maybe not that they go bust like tomorrow, but they are on the verge of going into a vicious cycle that will repeat over and over again until they manage to get out, which means like the profitability will be weak, which means like clients will leaving, which means like there's no trust in the stock and the bonds, which increases the cost of capital, and so on and so forth. So they need to do something to get out of this circle. We have seen this with Deutsche Bank a couple of years ago. It took them several years and multiple CEOs until they were at the point where they finally managed to turn the bank around. And I fear that is something that Credit Suisse is heading for at this moment as well.
JP, this is almost like a feedback loop, right? The worse the markets get, the worse are the options for Credit Suisse to get out of it. So what are you watching next?
Absolutely, and it's going to be very tough for them to make a change. And what they need to do is like really do a bold move here. And what we're watching for sure now is end of October, I believe it's the 27th, when they present their new strategy. And this strategy needs to be like 500% convincing. Otherwise, the market will not believe them, or there will be no relief for them at any point. So, and I think like the management knows that. And they just like have to figure out how to present that plan, how to make sure that the market believes them, and of course make sure that in the long run that they somehow readjust their profitability scheme so that the bank can survive in some way.
Thank you so much, of course, for all of the insight, J.P. Barnett, Jan Patrick Barnett. Now, coming up, the lady turns, but is it enough to calm markets and gain public support? We'll discuss UK politics, never dull, with election and polling expert Professor John Curtis. That's coming up next, and this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Welcome back to the Open. We are 20 minutes into the European trading day. You're seeing gains of 1.8%. It's a very solid session across European equities. US futures also pointing up after the gains of more than 2% yesterday. Stateside gains of 1.4% on the S&P. E-minis here in the UK, the FTSE 100 up by 1.4%, 94 points. Let's stay with the UK then. Some members of Liz Truss's cabinet are warning that key parts of her so-called economic revolution are unlikely to be realised. It follows efforts by the UK Prime Minister and her Chancellor to restore credibility following yesterday's U-turn. We are joined now by John Curtis, Professor of Politics at Strathclyde University, and someone who is unmatched, really, in their analysis of polling data over the years. Professor, let's start then with your analysis. We had these incredible polls out on the back of this mini budget showing an up to 33-point lead for the opposition Labour Party. Do the U-turns and does the announcement that the Chancellor could be bringing forward the fiscal plans, does any of that change the polling that we're seeing and the appetite amongst the population and voters for this Conservative Party?
Well, the attitude, Tom, of course, is that it's too early to know whether or not the U-turn has done anything to restore the Conservatives' fortunes. I can tell you that around 2/3 of people think that the government was right to reverse the hike in the reduction in the 45p rate. But then equally, we knew from the immediate reaction to the statement 10 days ago that around 2/3 of people thought it was a bad idea in the first place. I think the difficulty the government faces is that the fiscal event last Friday itself was somewhat unpopular, and you saw some easing in the Conservative position in the polls. But the real problem for the government is that the market reaction has fed into voters' concerns about this government and about its competence. And it's all very, very redolent of what happened on Black Wednesday, which, of course, was the last time a Conservative UK administration got into trouble with the markets. In that case, the markets forced the removal of the pound from the then European exchange rate mechanism. And this time, the markets certainly have played a role in helping to precipitate the U-turn that came out yesterday. And certainly, it's been pressure from the markets that's helped to ensure that the UK government is now going to speed up, telling us the arithmetic that supposedly underlines that statement. And the truth is that voters don't like to see their governments being buffeted by the markets in this way. And the opinion poll reaction has been very, very similar to Black Wednesday. We're looking at a 7.5-point swing against the government in a matter of 10 days, and that's exactly in line with what happened after Black Wednesday.
Fine, but this would be at the next general election. How long does Liz Truss stay Prime Minister for? Does the Tory party actually kick her out?
Well, certainly, I mean, another thing that happened in the wake of Black Wednesday was that the Conservative Party was perpetually divided, leading in the end to John Major calling a leadership election on his own, but then managing to win it. We're certainly now seeing the Conservative Party being seriously divided in the wake of the events of the last 10 days. We now know that Liz Truss was told by the chairman of the Backbench Parliamentary Committee that she had to get rid of the reduction in the 45p rate, that MPs wouldn't vote for it. And we're now seeing open season on one of the ways in which the numbers might be made to add up. That is by increasing benefits only in line with wages rather than inflation. The wages, of course, are not going up so much. Not only are we having backbenchers indicating they're not going to be very willing to back this, but we've actually already had one cabinet minister, one of the rivals to Liz Truss for leadership, saying that she would not be able to back it. And she's now inside Liz Truss's cabinet. So the problem potentially for Liz Truss is she is somebody who didn't have that much authority in the first place, only just got onto the ballot, who's now facing substantial rebellion and disquiet amongst her MPs. Now, frankly, it would be remarkable if she were brought down, given it's not that long ago since Boris Johnson was brought down, but certainly her tenure on office is less than 100% secure.
To what extent can she take, Professor, some relief from the timeline then? Because legally, we don't have to hold elections until, I think, January of 2025, and she has a 12-month period of grace period, arguably, under the current rules of the Conservative Party. That time frame could lead her and the government and the cabinet to readjust and regain some lost ground.
I will remind you, Tom, however, that Boris Johnson was protected by the rules when he was brought down at the beginning of July last year. If in the end a parliamentary party signals either by ministerial resignation or mass rebellion in the lobbies that they do not support their prime minister, then in the end they end up going whatever are the rules. Now, as I should say straight away, we're not at that point yet. There are a lot of MPs who are wanting this government to do well and are wanting it to recover. But the truth is the rules will not be a protection. Yes, this government does have 2 years. It certainly is, of course, is hoping that increasing growth, as it's trying to do, will mean that in 2 years' time, voters will say, you've done a great job. But one thing we have to remember again, it takes us back to Black Wednesday, is that in the wake of Black Wednesday, the UK economy did well, but that never was enough to restore voters' confidence in the Conservative administration. So the question is, will it be capable of doing so this time around?
Great. Professor, thank you so much for all the insight. John Curtis there, Professor of Politics at Strathclyde University. Now, coming up, EU finance ministers hold crunch talks as signs of division over energy policy start to emerge. Well, we're live in Luxembourg with the very latest. This is Bloomberg. nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands, the heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Turning down the heat, U.S. manufacturing data comes in soft, easing bets on Fed tightening, while the RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after an pretty embarrassing U-turn. Plus, crisis of confidence. Credit Suisse shares jump despite investor uncertainty over how the bank will pay for its restructuring. Tom, you look at the markets, and actually they're holding up strong for the moment.
This is a very, very solid session. It's broad-based across the sectors, and we'll have a look at those shortly. Gains of 1.7% across the benchmark, up 6 points. Over in Germany, a gain of 205 points, up 1.7%. The FTSE 100 here in the UK gaining 0.9% on news, by the way. This is part of the mix, not all of it, that the Chancellor is going to be bringing forward those fiscal plans with maybe that OBR scrutiny that many investors have been looking for. When it comes to the markets, the equity markets, that debate continues. Deutsche Bank saying we could be setting ourselves up for a very strong year-end rally. Others, though, Bank of America saying not all these positions have been washed out yet. So take your pick on which side you want to be in terms of that debate. Let's switch it over, have a look at the sectors then. The last time I checked, every single sector in the green. Again, the context, that rally that you saw yesterday stateside, the third best start to October since 1930. Travel and leisure up 3%. Technology as well benefiting as a move into bonds, yields lower, of course, and that a beneficiary for that sector gaining almost 3%. At the bottom of the list is the safe havens of utilities, just gaining 0.8%. This is a broad-based rally that we're seeing here in Europe. Whether it holds, of course, is going to be the question. Francine.
Now, European finance ministers, Tom, meet for a second day in Luxembourg, with energy taking once again center stage. The bloc is actually considering ways to tackle the crisis as Russia cuts gas deliveries and the continent prepares for winter. Now, we spoke with the German finance minister, Christian Lindner.
Our measure is targeted, and it is meant for the years 22, 23, and 24. And this is why, together, we have to make efforts to strengthening our common purchase on the international markets. We have to change the order of the electricity markets, but our package is not unproportionate. In fact, it is proportionate.
Now, for more on this, let's talk to Bloomberg's Maria Tadeo, who's covering, of course, that meeting in Luxembourg for us. Maria, good morning. So it seems that Germany's 200 billion euro energy package announced last week is sparking some concern. So is unity holding across the EU?
Absolutely, Francine, and that is really the big thing going into this Eurogroup. There's a lot of concerns, some questions around this mega package that was launched last week by the German government. 200 billion euros going into there. There has been some questions around whether or not this could break the level playing field in the euro area. Remember, not a lot of countries have the fiscal capacity that Germany would have, but also, Francine, from some of the conversations that I had yesterday, there was also some concern about the lack of communication coming from the German government. A few countries were taken aback by the fact that they did not get a real heads up on just how big the package was going to be. Of course, today you heard it from the German finance minister, who told me he thinks there has been, quote, some misunderstanding around this package. He defends it. He says it is big, sure, but so is the German economy, and so is the size of the problem for the German economy. But nonetheless, today the Germans on damage control, trying to reassure everyone that this is not going to be a problem for the euro area. But Francine, I'm not sure this message is really being fully read across. I can tell you already, there's some that will say we still need answers and we still need some reassurances about this level playing field.
Okay, Maria, interesting. So angst over the size of that German package and questions around their communication style on this issue. Maria, are we ultimately moving towards something that looks like a recovery fund 2.0?
Yeah, and of course, if we go back to solidarity and unity, and those are the two words, Tom, I can't tell you the amount of times that I've heard them over the past 24 hours. And it is a very good question to be asking this morning, because there is an op-ed that has been published in a number of European newspapers by Gentiloni, the head of the economic affairs for the EU, and the internal market commissioner, Thierry Breton, in which they now openly say the European energy crisis will require a joint response. They point to something like the short program, which is a lot of jargon, but essentially what it means is joint loans that would be backed by the European Union. They say that could be an option. Christian Lindner, however, also commented on that this morning, and he said he does not see more debt as a solution to this crisis.
Okay, Bloomberg's Maria today on the ground in Luxembourg, following all the twists and turns, the tension amongst the leadership there in terms of their ability to address this energy crisis. Let's stick with Europe and discuss finance on the continent. Portugal's Novo Banco has been shedding assets and selling soured debt to reduce its non-performing loan ratio. We are joined now by Novo Banco CEO Mark Borg. Mark, thank you for joining us in the studio. So as you go through this important process at the bank and with your history with Irish lenders, and you look at what's happening, the overlay, of course, of higher rates, recession concerns, inflation, the energy crisis, how are you navigating this environment?
Well, let's take the rates first, and then the inflation, I suppose, as a joint question. I mean, in the period since the start of the year, 6-month Euribor has moved, say, from -0.5 to plus 1.8, and the base rates from 0 to 1.25. And that's a significant move. But if you look at it in historic terms, we are still actually normalizing. We have probably reached the bottom level of what would be an average over a 40 years period. From a Portuguese economy and Novo Banco's point of view, you know, we're not seeing a significant uptick in stress or a significant uptick in formation of NPLs, and this would be a shared experience across all of the banks.
Mark, what about net interest margins or net interest income or mortgage demands?
Well, on net interest income, I think the important thing is to say, again, if we look at this in an overall business model context, we will see inflation coming through. We will see inflation affecting the wage negotiations and across general services. But for banks, because we are normalizing, actually the business model is supported. So for years and years and years, banks have been struggling with much lower net interest margin, have had to repeatedly look for efficiencies, digitization, better models for sustainability. As you normalize interest rates, then we have a more sustainable banking system, even though we will inevitably have increased provisions and increased...
And yet the share prices of banks have not correlated with the higher interest rate. And many would have come out at the beginning of the year said, you want exposure to the banks, rates are going up, but it hasn't played out that way. Is that recession fears?
Well, I mean, I think that there's always going to be a lag. Banks have been, I suppose, pariahs in valuation terms for so long. but it is inevitable that if the rates environment normalizes and stays like that, I mean, doesn't actually move into the other side of the spectrum, then you have a more sustainable banking system. And most banks enter this in a much better state in terms of balance sheet than they would have the previous financial crisis.
But Mark, what do you mean by pariahs? Because what, in terms of valuation, you don't think banks are valued properly, or because they just need consolidation? It's fair to say that we're probably overbanked in Europe.
Absolutely.
Right.
But when I say pariahs, I mean if you look at valuations which are 0.3, 0.4, 0.5 times book, that tells you that banks are unpopular and not considered a good investment. Is there a potential for consolidation? Yes. I mean, clearly a number of economies are heavily overbanked. Yep. My experience personally would have been in places like Ireland, where a concentration now has taken place, that for 10 or 20 years, the idea of consolidation was always in circulation, but it takes some sort of catalyst for that to happen. In our case, in Portugal, we're still heavily banked, but probably more concentrated than most. Our approach would be assume status quo and be an independent and compete and endure on that basis.
And can we get an update from you on the NPL target then? You're targeting, you want to get it down to about 3.5%. You've been selling assets. You recently sold your headquarters in Lisbon. Where are you in approaching that 3.5%? When do you get to that 3.5% target on NPLs?
Yeah, we set out last year a 5% target as part of our kind of strategic day, or our strategy day. We set out the 5%. I think we will make that 5% this year, or within a very small distance, and then we will go for between 3 and 4 over our planning period, which is 2 to 3 years. And that will come from a combination of individual restructurings and likely portfolio sell down.
Mark, what's it like working for private equities? What's your mandate? Does Lone Star want you to IPO it? Are you looking at takeover targets? Do they want you to grow the business?
Lone Star, like any other owner, wants to have a successful business. So the first thing,
a listed one?
Not necessarily, but if you're a bank that wishes to be independent, compete and endure, then the one thing you can aim at is the public markets. Whatever happens then happens, whether other people come along or whether you have an opportunity to expand the business. From our point of view, the important thing is to be independent, to be sustainable, to be able to compete, to endure, and then you effectively have your own destiny in your own hands.
Do you know of any conversations that Lone Star has been having, might be having, with any potential acquirers of the bank?
Absolutely not. I mean, Lone Star, the shareholder, shareholders are having conversations with many people, I'm sure, at the time. Our job as a management is to prepare the bank and to make sure that we have it in good shape for whatever happens.
So what does good shape mean? Again, the problem, and if we go back to the valuations being prized, is that a lot of investors don't really understand the purpose of some banks, if I'm honest. So what's your template? Where do you want to grow? Where do you want to cut?
Well, for us, this was a very complex bank, but now we are a pure play retail and corporate. And corporate in a Portuguese context means an SME bank.
Yeah.
In those, they are the areas that we have expertise. They're the areas that we have history. We've completely rebuilt our retail network as an omni-channel delivery mechanism, which actually is able to compete and endure in a low interest rate environment, and should be stronger as the rates environment normalizes. Yeah. So we bet essentially on those two, being very clear about what it is we do and very clear about what it is we don't do. It's a simple retail corporate strategy, and you've seen it, in many different jurisdictions, including my own previous one.
Is there Mark, before we let you go, is there a need to raise additional capital at the bank?
No. The important thing to note is once you are a capital accretive bank, once you are making money, and we divested, we have got our legacy down to less than 5%, and the bank is consistently capital accretive. So we will generate between 80 and 100 basis points this year. We've had 6 quarters of successive profitability. You don't need to raise capital if you're generating it yourself.
All right, Mark, thank you so much. Mark Burke there, the Novo Banco Chief Executive Officer. Now, coming up, Elon Musk causes an uproar after calling for Ukraine to seek appeasement with Russia. So what do the comments mean for Tesla? We'll debate that next. This is Bloomberg.
has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open, everyone. We're about 45 minutes into the European trading day. Now, stocks and bonds, you definitely see a rally as peak rate wagers seem to surge. Again, it's a pretty volatile market, so it could move either way. For the moment, European stocks gaining some 1.8%. But the real story, the one I've been wanting to talk about all day, is the Tesla boss, Elon Musk, under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. Now, the SpaceX founder and chief executive also called on Kyiv to give up Crimea for good. Now, for more on all of this, we're joined by Bloomberg's Craig Trudell. Craig, I love the fact that we go to the card chart to talk also about geopolitics. I mean, it's just a strange and bizarre situation. Will this backfire? You know, does it basically elevate Elon Musk as kind of like a master of the universe, or does it backfire because people will stop buying the cars?
Well, I think a lot of consumers have obviously looked the other way through a lot of his many controversies. I mean, this sort of reminds you of you know, back during the pandemic when he sort of inserted himself into, you know, making predictions about when COVID cases were going to go to zero. That didn't go so well. He inserted himself into the Thai cave rescue back in 2018 and sort of, you know, tried to come to the aid of the soccer team that was stuck in the cave. He does seem to have this tendency to kind of throw himself into the news cycle. There's no doubt about that. And certainly, you know, people have been frustrated. Even some of his fans have been frustrated when he's acted out. But certainly there's a risk of a sort of piling on effect here of like, enough's enough, you know. I'm not so interested in driving around in a car built by a guy who acts this way.
Yeah, Craig, I mean, we've been discussing this, whether we just overlook it as the bluster of an egotistical CEO, as some might claim, or whether we should pay more attention to it. So we're talking about the sales for Tesla, but also there's the question marks, arguably, around corporate governance, and a reminder that there is this concern from some investors.
I think that's definitely a legitimate one, just based on the way that we've, you know, seen the way the board sort of failed to check him, you know, time and time again, whether it was the, you know, funding secured issues of 2018. My colleague Dana Hull in San Francisco years ago reported about how he, you know, had pushed someone who was leaving the company. The board sort of looked at it and, you know, decided not to do anything about it. You know, even in the text exchanges that have come out of this, you know, Twitter litigation, you had one of his former directors of Tesla, you know, really sort of, you know, fawning over him. This guy was supposed to be the lead independent director at Tesla, and you really have a case where a lot of his, you know, friends and allies, you know, really sort of speak to him in a way that sort of suggests that, you know, you don't question him. You're very sort of, you know, friendly and supportive of him through thick and thin. one of his friends talking about, we'll go to the mattress for you, ride or die. So this is a guy who, clearly sort of values those sorts of relationships.
We'll go to the mattress for you, ride or die. Craig Tudell, thank you, as ever, bringing colour to this story. Did it need more colour? The twists and turns, of course, and what to read into this decision by Elon Musk to wade in to the geopolitics of Ukraine. Thank you. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. 2 European commissioners are calling for the issuance of joint guaranteeing debt as the continent continues to face up to an energy crisis. Thierry Breton and Paolo Gentiloni wrote in op-eds in several newspapers across the region that the situation means Europe is at another crossroads. The EU's €1.8 trillion emergency package during the pandemic was the first time the bloc issued joint debt. Officials in Florida now say 68 people were killed by Hurricane Ian as the damage bill mounts 5 days after the storm struck. President Biden is scheduled to visit Florida on Wednesday to survey the damage from what he described as one of the worst storms to ever hit the U.S. One estimate says insured losses could reach $57 billion. Ukrainian President Volodymyr Zelensky says liberating settlements from Russian occupation is now the trend, as his forces press further into territory held by Moscow. According to Zelensky, the strategic eastern town of Lyman has now been fully cleared. The Kremlin says it still hasn't finalized the borders of 2 of the 4 regions that it laid claim to last week after so-called referendums. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thanks so much. Alice Atkins in London. Coming up, we'll be looking at the top market moves after the first hour of equity trading. We'll talk Porsche, we'll talk Greg's, yes, the sausage rolls, and we'll also talk Credit Suisse. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to the Open. 53 minutes into your European trading day. The dollar is down. Other equities, assets are up. A risk on as a result of softer dollar. Dollar down by 0.4%. You're seeing solid gains across equities, gains of 1.8% on the benchmark. And in the UK, a bid for gilts, particularly at the short end, yields down by 19 basis points.
Now let's take a look at how the markets are moving in the first hour of equity trading. The one and only JP Bartlett is here with, of course, still the best background in the business. So what's driving the bounce, JP?
Very good morning. So when I was reading the headlines yesterday that people are attributing the bounce initially on the miss on the ISM manufacturing index and taking this as an indication that the economy is cooling and that the Fed pivot point could be near, I was like, oh, come on, this is a bit silly as an explanation. But it shows you like the market was so bearish going into this number that everybody was just like keen to buy the dip, but there was no reason to do so. So they took the next best thing and that was it. And now we're seeing like all the buildup of the bearish positioning being unwind. To some degree at least, and that's what's driving the market yesterday and today, I believe.
So JP, tell us, as I look at what's happening in the bond market, where it is pronounced, particularly at the short end, whether it's the US 2-year or the gilt 2-year, does this continue?
Well, it could, yeah. I mean, yields have rallied a lot in the last couple of months, and that was a big pressure on the stock market. But I would be a bit cautious here. If you look at the MOVE index, which is basically the volatility index for the bond market, similar to the VIX index for equities, this is still pretty high, actually almost near its record high. So that shows you that there's still some tension in that bond market. And that can flip around at any point. So I wouldn't build too much hope on that one.
Yeah, I was going to ask you, where do you see the most volatility? Is it currency or bonds?
Well, I think it's both. And that's a major theme of this year, that we saw like volatility across all asset classes and especially across the risk spectrum. And that's causing ripple effect into the market. We saw correlations between the major asset classes, especially currency, bonds, and stocks changing dramatically over the last couple of months, which creates problems for those people managing portfolios. And that's something that's probably going to persist a little bit longer and can always moves that are violent in both directions. So we saw the move down the last 2 weeks. Now we're seeing a violent or rather violent move on the upside. And I'm sure this will persist a little bit longer.
Jan, Patrick Barnett on these violent moves in the market and today to the upside. Thank you, as ever, for the analysis, Jan. And just checking back in on the benchmark here in Europe, gains of 1.8%, very solid upside over in France. The CAC 40 up 2.3%. Here in the UK, the FTSE 100 is up 80 points. That's a gain of a little over 1%. Every single sector in the green. The dollar is down by 0.4%. That is leading to some upside for the euro, and the pound up 0.6%. Bonds are bid, yields lower by 18 basis points at the front end of the UK. The US 2-year at 4%, down 9 basis points. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth. but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Turning down the heat while U.S. manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after that embarrassing U-turn yesterday. Plus, crisis of confidence, Credit Suisse shares jump despite investor uncertainty over how the bank will actually pay for its restructuring. Now, let's check on the markets because there is quite a lot going on in the markets. European stocks, but also U.S. futures pointing to a higher start. Now, they're extending their advance that really started yesterday. This is as that weak U.S. manufacturing means that there's a bit of repricing going on how the Federal Reserve, how hawkish the Fed can actually be. The FTSE 100 getting 1.3%. If you look at the sectors, most of them that make up the 19 groups that make up the S&P 600 are actually gaining. The U.S. dollar 3,205. We use the U.S. dollar Bloomberg index. And then the Australia 10-year yield, 3.73. This is after that reversal from the RBA. Many people saying that actually this is something that the Fed should also pivot to. Otherwise, we're going to see messy bond markets. All right, let's get to the European map, if we have it, just to see if we have a difference between France and Germany and the like. Our Maria today was also in Luxembourg looking at the energy plan. For the moment, we're seeing gains across the board. So the Aussie dollar and bond yields tumbling after the central bank hiked less than expected. It follows the S&P 500 yesterday, ending its best session since July. As investors paired expectations of how aggressively the Federal Reserve will hike following weaker than expected manufacturing data. Now, Yardeni Research President Edward Yardeni says the Fed should actually end tightening after one more rate hike.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. And these are very restrictive monetary developments. I think they got one more rate hike coming in early November, and that'll be it because the financial stability issue will pop up as primary concern.
Well, we're now joined by Morgane Deladon, Head of Investment Strategy for Europe at Global X ETFs, and Christina Kino from our markets team. So thank you both for joining us. Christina, I don't know what does the Fed look at the RBA and say, maybe I should learn something from them?
It's probably a little bit of that element, Francine, but of course, these are drastically different economies, right? I mean, the Fed and the U.S. economy is one thing, but Australia is very much a small, open economy. It's very exposed to the global gyrations gyrations in growth and inflation and monetary policy. And so it makes a lot of sense that they're now kind of, I suppose, easing back a little bit from that really fervent tightening stance earlier in the year, probably looking towards what's happening in China, of course, their biggest trading partner as well. But there is something to be said about, you know, a small central bank kind of trying to pave the way for a bit of a pullback now in tightening policy.
Yeah, so forget peak inflation, Morgan. Have we reached like peak interest rate hikes?
Very good question. I think it's hard to say right now, but it seems that the risks are more to a dovish turn towards the end of the year rather than more hawkish surprise from central banks. If you look at the current pricing, one thing is quite obvious is the US is doing better relatively to other regions on the economy front. So the real question is, will the Fed reach peak hawkishness now? And I think it's likely to be the case. I think the differential between interest rate in the US and Europe, for example, will remain stable.
So Morgan, what would you be buying right now?
So definitely positioning more on the defensive side. I think there is a case now to look at a more barbell approach with some short-term exposure and long duration potentially as yield curve become more inverted. So looking at this for the bond market. In the equity market, staying allocated to more defensive sectors, consumer staples, healthcare seems to be still a quite interesting sector at the moment.
And Christine, I mean, you see definitely assets getting a bit of relief now, but how long can the dollar easing last?
Yeah, big question, Francine. I mean, I think a lot of that will depend on some of the key data coming up in the U.S. Jobs Week, of course, we know that usually does turn the tides when it comes to what the Fed is going to be doing next. So that's very key. But I think it's quite interesting because, you know, it does feel a bit like the peak is a little bit past us now in the dollar, just because of what you're seeing in the U.S. economy as well, right? I mean, we're starting to see signs of, for instance, of the housing market starting to roll over from its very frothy levels over the summer especially. And so just some of these key economic indicators kind of maybe giving the Fed some reason to maybe hold up a little bit on that very fervent easing stance that they had earlier this year.
Yeah, and of course at the heart of some of the current market turmoil is also what we see in terms of recent surge in gilts, especially at the long end. Now, shares in Credit Suisse also trading higher today, just one day after touching a record low. The Swiss lender's credit risk gauge jumped to an all-time high on Monday after the chief executive failed to calm markets on capital levels and liquidity. So joining us now to talk about all of this, and then we'll go back to Christine and Morgan, is Steve Ahrens. Steve, so first of all, how serious is the danger to Credit Suisse?
Well, hey, Francine. I mean, it's a very serious situation. If the CEO keeps sending out internal memos to staff to reassure them, there's something going on, right? They've said they're going to update on the strategy at the end of this month, along with three-quarter earnings. But the markets are so tense. I mean, there's so much uncertainty generally, but particularly about Credit Suisse. There's a lot of pressure on the bank now to maybe say something earlier than that. So if they want to head off all the volatility that's going on in their share price and their CDS too, they will have to do something, and so the pressure's on.
And so, Steve, the worse the market gets, right, the worse the options for Credit Suisse are. So how fast do they need to act?
Well, like I said, they're giving themselves really until the end of the month, but it seems like there's so much anxiety now, so much speculation. I mean, Bloomberg, we've had a lot of scoops on what could happen, and there's a lot of other media out there chasing this. There's a lot of speculation. There's a lot of stuff on Twitter. There was a tweet that set off speculation. There's so much going on. It's just a personal guess, but I think the pressure is so strong they may have to do something before actually the end of this month.
All right, Steve, thank you so much. Steve Ahrens there looking at Credit Suisse that we're dubbing Crisis Suisse. It must be pretty depressing if you're one of those trading floors. Christine, again, is this symptomatic of something that Credit Suisse is living through because of the specifics of the bank, or could it actually turn into something worse for the banking sector as a whole?
I mean, it sounds like the bulk of the issues are quite idiosyncratic to Credit Suisse, as we were discussing earlier, Francine. But, it's probably symptomatic of the broader environment in the sense of it's a more difficult environment for banks and businesses in general, right? Because it's quite a lot of uncertainty with regards to where interest rates are going and how high that's going to go. And then also, on the other hand, a lot of volatility in market trading, which usually is a good thing for banks, especially when it comes to their trading books. But then also with that comes some weakness and uncertainty in investor and consumer activity. So all of these put together, it really is quite a challenging environment for banks in general. And it could be something where, at the end of all of this, we will see quite a bit of differentiation between some of the stronger links in the sector versus the weaker links, as we're seeing with Credit Suisse.
Yeah, is that your take as well, Morgan, that this doesn't necessarily snowball into something bigger?
I think what we're currently seeing is a change from a month ago is other asset classes than bonds are pricing higher in recession risks. And we definitely see more volatility in the equity market, but also other asset classes, especially in the precious metals. Gold has rebounded, silver has rebounded. So there is a sign that the market is preparing for more turmoil to come, as also central banks are about to step up their quantitative tightening. So reduced central bank liquidity is probably adding fuel to this nervousness.
Yeah, and Christina, I mean, on that, is there a danger that actually this lack of liquidity will really exacerbate some of the moves like we saw maybe 8-9 months ago, that, this is the pipeline. We don't usually worry about it, but can it be, I guess, turned into something that's a market event?
That's certainly always in the back of minds of investors, right? I mean, this is something, for instance, really cropped up as an issue at the height of the pandemic, and that's where we saw central banks really step up their ability to manage short periods of liquidity stresses. And you would hope that some of those preparations that we saw a couple of years ago would still be in place and would be provide quite a robust source of liquidity at the moment. But again, a lot of unexpected events this year that really hampered a lot of parts of liquidity in the market. I mean, the Russia situation still undergoing, and that has really kind of brought up some of the stresses that were reminiscent of the pandemic era. And so I think we will see kind of tests of liquidity in terms of high stress periods, but not necessarily a breaking point.
All right, thank you both for joining us. Morgan Deladon there, Head of Investment Strategy for Europe at Global X ETFs, and Christina Kino from our markets team joining us today. Now, coming up, warnings over the Prime Minister Liz Truss's credibility. Will go live to the UK Conservative Party conference for more. That's coming up next, and this is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
August jobs were right on target.
Pretty much in line with what Wall Street expected. A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, the Tesla boss, Elon Musk, under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. Now, the SpaceX founder and chief executive also called on Kyiv to give up Crimea for good. Now, for more on all of this, we're joined by our card czar, Craig Trudell. So, Craig, this is not really about Ukraine and, you know, what should happen. This is about Elon Musk, who feels he can tweet about everything and anything. Does it, and actually Tesla shares are up 2% in pre-market. Does this hurt his business or does it help his business?
I think it's hard to say. It's certainly the case that people have kind of looked the other way or put up with his antics, you know, going back many years, right? And we've republished a story from just a couple of months ago this morning about this idea that, you know, would-be buyers or customers of Tesla are sort of turned off by Musk. And I think, you know, we've seen more of that, you know, just in the last, maybe say 6 months when his politics have kind of changed.
What was the quote of the day? I mean, there's a brilliant quote in this article.
Yeah, there's one of the consumer surveys that we cite in this story, you know, talks about this idea that, it refers to this idea that the sort of worst attribute of the Tesla brand among a lot of those surveyed, people cited Elon Musk. And, you know, one of the people who conducted this survey talked about this idea that, you know, some consumers did tell them, I love my car, but I really wish I didn't have to defend my choice of car, you know, because of the latest Elon Musk tweet. It was something to that effect.
But at the same time, he's a little bit enigmatic because he's also sent Starlink to Ukraine, so you don't really always know on what side of the fence he sits on.
Totally. I think he's tried to have it both ways here. You know, it was really within a matter of days, maybe weeks after the initial invasion that he stepped up and you know, sent Starlink terminals. He even sent generators and other products to Ukraine, engaged with officials in Ukraine about you know, the thank yous and your welcomes for sending this your way. At the same time, he's also talked about, you know, he's joked about, you know, people on Twitter supporting the current thing and talked about woke mind virus. So He wants to kind of chide people for, blindly supporting Ukraine, and yet at the same time, he's very clearly inserted himself into this even before yesterday when he started doing this tweeting.
Many people won't know who the Volkswagen chief executive is. Is that not, though, any bad publicity, even bad publicity is good publicity kind of scenario?
That seems to be his bet. I mean, he clearly likes to be in the news. He likes to be, trending on Reddit, trending on Twitter. And there's really sort of no controversy that he shies away from, making himself a part of.
That's a very diplomatic way of putting it. Craig, thank you so much. Craig Trudell, an Elon Musk watcher. Now, a rally in global markets seems to be extending into a second day, lifting also U.S. indices or futures and European stocks. Investors wagering that central banks may slow the pace of monetary tightening. Coming up, we speak to the French finance minister, Bruno Le Maire. That's as ministers gather in Luxembourg to discuss the energy crisis. That interview up next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Turning down the heat, U.S. manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after a pretty embarrassing U-turn. Plus, crisis of confidence. Credit Suisse shares jump despite investors' uncertainty over how the bank will actually pay for its restructuring. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, European finance ministers meet for a second day in Luxembourg, with energy taking center stage. That's as they consider ways to tackle the crisis since Russia began cutting gas supplies. Let's head over to Luxembourg, where Maria Tadeo is standing by with the French finance minister. Maria, over to you.
Thank you, Francine. Good morning. And we're joined exclusively on Bloomberg TV by the French Finance Minister, Bruno Le Maire. Thank you so much for joining us today. This is a Eurogroup that has been, well, hectic, but also very interesting. And you can see there's some tensions building behind the scenes. But before we get into that, I want to get your outlook on the European economy, because the idea was recession is almost inevitable. But it seems to me the story is way more complex, but also more nuanced when you look at storage, when you look at demand destruction. So overall, how do you see things?
I remain pretty optimistic, even if, of course, we are facing difficult times. We have an unprecedented level of inflation since the creation of euro, which raises a lot of concern among our citizens, among private companies. But I will give you my strong belief. If we remain united, all the 27 member states, we will overcome those difficulties by mid-2023, I would say. The key point is to stand united. And that's why I really think that there is a need for a global action plan at the European level against inflation.
And can I ask you, you talk about solidarity, and well, I think I've heard you speak now in 24 hours 3 times, and it's a word that comes often in your speeches. When you say solidarity, when you say unity, is that a message to Germany? And what does a level playing field mean when you have 200 billion euros to spend?
It's a global message to all the member states. And you know, solidarity is part of this European action plan that we are proposing against inflation. The first point is energy efficiency. We need more energy efficiency, which means that we need to reduce our energy consumption. And I really think that we must do better as far as the reduction of energy consumption is concerned. The second point, as you just said, is solidarity. I think that we could think about a proposal like the SURE mechanism that proved to be very efficient during the COVID crisis. We could have the same kind of mechanism against the consequences of inflation for the countries that are mostly hit by the consequences of high prices. I'm not talking, to be very blunt, about common debt issuance. I'm talking about a SURE mechanism, which means the possibility of raising money at the national level, but with the guarantee of all European member states. This would be the second point of this global action plan. And the third point is to have targeted measures, targeted support to private companies that are exposed to the international competition and that are paying too much for their energy.
So you come here with a plan based on everything that you said. Essentially, there's a
global French plan we have been discussing with the French president based on solidarity, a kind of SURE mechanism, targeted support to the private companies that are facing these high prices and that cannot support this, cannot face these very high energy prices, and of course the necessity of reducing our energy consumption.
But you're saying I'm not calling for a recovery fund, and that's important to clarify.
I'm not talking about common debt issuance or a recovery fund or something like that, because we know that it might raise some difficulty among member states, and there is a need to decide quickly. I'm not talking about an action plan on which we should discuss over the next month, over the next weeks. We must decide now, because inflation is hitting our economies, our citizens, our private companies, our industry right now. So there is a necessity for deciding in the coming days, not in the coming weeks.
And of course, President Macron met with Scholz yesterday, and they will meet again later in the week. But in your conversation with Christian Lindner, I spoke to him in the morning. He said, I don't see the need for more debt. I don't see the need of this big plan. We have what it takes for the time being. So essentially, you disagree.
That's exactly what I'm not talking about, common debt issuance. I'm just talking about the possibility at the national level to raise debt, but with the support and the guarantee of all European member states, which means that you could borrow money at the lowest price. And that's a key point for many member states. But of course, I've been talking with Christian Lindner yesterday. We are working very closely together, like President Macron did yesterday with Chancellor Olaf Scholz.
And can I ask you, that's on the European level where you make your points very clear. You have a plan and you hopefully...
I made these points very clearly yesterday, explaining that we should not underestimate not only the financial, not only the economic, but also the political consequences of inflation. We should never forget what happened in Europe when we had a very high level of inflation. Once again, this is an unprecedented level of inflation since the creation of euro. There is a necessity to decide. There is a necessity to have a global action plan and an economic response which is not limited to one single decision or one single action from every member state, but which is based on a global framework on which I'm deeply convinced that we can find a compromise and an agreement.
And of course, a lot of this is back to energy, and one of the components here has been nuclear. And nuclear for France was everything. It was about the sovereignty of the country. EDF, this is an emblem of Made in France, but when you look at the fleet, half of it is not working. Electricity production is not really working for the French either. You're paying a lot of money for this. You have new management coming in. You know the criticism that this company has been very badly managed. Is it going to change? Are we going to see a turnaround at EDF?
It's going to change because we have a new management for EDF, and of course the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened because there is a need for nuclear plants and there is a need for nuclear electricity. If you want to face the necessity of fighting against climate change and having those radical changes in the way we are reducing CO2 emissions, there is a need for nuclear energy. And I really think that the mix of nuclear energy and renewable energy that has been proposed by President Macron is the right strategy for France and might be the right strategy for many member states.
Maybe that's a hint to Germany, which is, of course, debating what to do with nuclear. But going back to France, of course, you mentioned now your country. You've put out your budget. You know some of the reaction to it. Perhaps it's too optimistic. You say you don't want to talk down your economy. How do you defend a budget in such a complex scenario where you're still more optimistic than the average? I mean, the numbers speak for themselves.
I'm just defending my budget looking at the current situation in France. The level of growth in 2022 should be 2.7. There was many observers explaining that we would never reach 2.3 or 2.4. We have 2.7% of growth in 2022. We are creating jobs. The level of investment of private companies remains pretty high. So that's why I'm so much optimistic, so much determined to provide growth to France for 2023.
You say the naysayers will get it wrong, but just as a final question, because this also feeds into this budget and fiscal responsibility, the pension reform, I'm sure you knew this was coming. It's a perennial issue for the French government. There's many out there who say the window is just closer and narrower, and you're not going to do this as you hike energy bills, so you have 2 months to get it done. Will this pension reform happen? Will it go through this year?
Yes.
Yes, clear answer.
Yes, my response is yes. The pension reform will enter into force next summer 2023. We have been promising this very important reform during the presidential campaign, and we will stick to our promise.
Well, and of course, we'll speak if it goes through again, I'm sure, to talk about whether or not it actually does improve the fiscal finances of France.
Of course.
Mr. Le Maire, thank you so much for joining us on Bloomberg. Always good to see you. And Francine, that was the French Finance Minister, Bruno Le Maire, joining us here as this Eurogroup continues on day 2. And you can see there's a lot to talk about in this one.
There is a lot, and a lot of times, great interview, Marie, a lot of times we look at it, of course, through the markets lens, but Monsieur Le Maire, they're saying very clearly it has huge political implications. Actually, if you see higher inflation, it could really break governments and change election results. Maria today in Luxembourg for us. Now, coming up, the tax cuts may be gone, but the vast majority of Liz Truss's economic project remains. We'll get the city's perspective on the plans. That's coming up next, and this is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Australia's central bank has surprised investors by raising rates at half the pace expected, sending the Aussie dollar and bond yields tumbling. The RBA ended a streak of half percentage point hikes, opting instead to raise the cash rate by 25 basis points to 2.6%. Only a quarter of economists polled by Bloomberg did predict the move. Now, the judge in the Theranos fraud case has decided to delay the sentencing of former CEO Elizabeth Holmes. He wants to review the testimony of a key witness for the government, former Theranos lab director Adam Rosendorf. Holmes has argued she deserves a new trial after Rosendorf allegedly showed up at her home in August, trying to speak with her about his testimony. Bloomberg has learned that the Biden administration is planning to announce new restrictions on China's access to U.S. semiconductor technology. Sources say the Commerce Department will roll out a package of rules this week to govern which semiconductor technologies can be exported to China. Under current guidelines, U.S. chip makers can sell machinery for use in China under certain circumstances. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the UK government has, for now, abandoned its plan to cut the highest rate of income tax. But that policy only a small part of the so-called new economic deal that Prime Minister Liz Truss wants to set in motion. Now, to get the city's perspective on this plan, we're joined by Mark Austin. He's partner at Freshfields, also helped write a paper on what regulation is needed to kickstart the IPO market here in the UK and London. So, Mark, thank you so much. We did a wonderful podcast together, actually, about a month and a half ago, and we were talking about Amsterdam, in certain cases, doing so much better than London. And since we had proposals from the government, where are we now in terms of attracting IPOs and getting things through the pipeline?
Well, I think there's a really good conversation going on, actually. And actually, the whole sort of policy direction, stated policy direction of this government has been very helpful.
Yeah.
The new music around actually needing to do things a bit differently, actually encourage growth and be bold and brave where perhaps we haven't been before, challenge some orthodoxies, I think is something that the city generally is leaning into and thinks is a good thing to embrace.
But not the smart money. This is the problem, is that you know, they maybe went too far in some of the policies, and does it mean that they'll have to roll out some of the anti-regulation rhetoric that was for the City of London, not for the tax cuts for you know, the elite?
I don't think so. I mean, I think the deregulation sort of mood music, I think, is helpful because I think that's the tenor of the city at the moment. I mean, across the top, things like tax cuts, etc. That's a sort of political point. Bankers' bonuses is a more political point. But there are lots of they're effectively non-political points that sit underneath that because whether you're left-wing, right-wing, centrist, actually the future success of the City of London, given its contribution to the UK economy, tax take, jobs, general economic growth, is a no-brainer. And so actually, the conversations, the reform conversations that are taking place in the city at the moment, I think everyone's quite heartened by the direction of travel of this administration.
I mean, it's a no-brainer unless it's consumers that pay the price. So there's also talk about, regulators coming up with rules and then ministers being able to supersede them or to say, actually, no, we'll do it this way. Is it consumers and the common man and woman that could pay the price for that?
I don't think so if we get it right. I mean, the FCA, for example, has a statutory objective of consumer protection. And clearly, given the macroeconomic and geopolitical environment at the moment, consumer protection is a key tenet of everything we need to do. So we need to reform, keep the city relevant, but also make sure we have appropriate protection. But the key is, what the real thing in the question in that is, how do you get that balance right? And actually, there's probably a discussion to be had around in the capital markets in London. Perhaps that balance should be slightly more nuanced than it is in some other areas. For example, you and I as mortgage holders and interest rates, etc. But actually, my mother in Yorkshire, thinking about investing in an investment product, perhaps the balance should be slightly more weighted towards risk-taking in the capital markets, which I think is something in London that we've slightly lost in recent years.
What do you think the concern is now? So you were telling me that Amsterdam, for example, is much more nimble in pitching for some of this stuff, so they're attracting, of course, business. But because of the U-turn, which is different to what we're talking about, so this is not for the city, but because of the U-turn, do investors kind of think, well, I'm not sure what's going on in the UK right now?
I think there is a little bit of a question around that, yes, around the investability of the UK. But that is a perception point as much as anything. And actually, a lot of the conversations that are happening now are seeking not just to reform the black letter law, black letter regulation, which is what my review is about, it's what Hill was about, it's about what also the other reviews were about. It's actually about changing the narrative in the UK, changing the perception of the UK, and making it clear that we are a insurgent, fleet of foot, appropriately protected, well-regulated environment that nevertheless offers the best place for companies to come and list.
So where do you think we'll be in that review? I think some things are going to Parliament. We have a new city minister.
The city minister has a lot of energy. He's great. I mean, he's been going around talking to everybody, and he's very embracing of this drive. And I think that that whole reform agenda is going to move forward with some speed. And there's a lot of people in the city who are feeding ideas to that, thinking actually about what can we, given the welter of stuff that's going on at the moment, the danger actually is there are so many conversations that they all get lost or that they cross over each other. And so actually part of the art at the moment is working out what are the things that we can do in the shorter term that have the maximum impact for the city as a whole.
And would this be actually reversing, I guess, maybe some of the talent loss after Brexit, or this is a new set of rules?
No, it's reversing some of the talent loss, but it's actually not new sets of rules, it's actually, I think, refining sets of rules and actually working out. London, for the last 20, 30 years, has built up an architecture that it could bear when it was necessarily the default, in most cases, the default financial centre, default listing venue in Europe. It's not necessarily that anymore, as we've discussed before. And actually, the conversation is about, in order to keep London relevant, as relevant on the global stage for the next 20, 30 years, what do we need to do in terms of being more nuanced and thoughtful about our rules, more principles-based in how we reform, rather than actually necessarily tying companies up and investors up in black letter.
I mean, I think there are like 15 or 20 points of what we should do. What do you think will get done in the next 12 months? What do I think will get done in the next 12 months? I think that we will see regulatory reform completed, so that by end of Q2, Q3 next year, we'll have a regulatory system that's more or less bears comparison with any other listing jurisdiction in the world. That will happen. I think we will see some further conversations around investor attitudes in London. I think we'll see some further conversations around pension investment, greater DC pension investment in markets. I think we'll see some more conversations about tax breaks, joining up across public and private capital markets in terms of the tax system that we have. I think there's lots of quite sort of, I hate the phrase, but sort of easy wins that can happen in terms of actually just changing the narrative a bit. Are you still speaking to the government now, or are they distracted by everything that's going on?
No, they're fully engaged. They are fully engaged. I mean, there's a lot going on.
So you think we could see something in the next, even couple of months? Is it something that could be done before the end of the year?
I mean, there's a lot of conversations going on. It's not for me to say when they will come forward with any proposals, but there is a lot of activity and a lot of very good conversations happening.
All right, Mark, thank you so much. Mark Austin, their partner, Freshfields, of course, also one of the main authors of this review, and a good way of looking at the City of London. So we'll get him back on to bring you all of the very latest on that. Now, coming up, we'll be looking at the top market moves this morning as a global rally continues. This has to do also with some weak data we had in the U.S. The stocks, bonds rallying, the market now pricing in a peak rate wager, which is lifting off a lot of these markets. This is Bloomberg.
possible the industry is in an arms race that will lead to spending itself into an oversupply. I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's take a look at how the markets are moving after a global rally extended into a second day, lifting U.S. indices, futures, and European stocks. Well, joining us now is JP Barnett. JP, what's driving the bounce?
Well, yesterday we had some weak economic data out of the U.S., which sounds counterintuitive. But the market took this as a sign that the economy is cooling and that this maybe creates a pivot point for Fed policy and for the rates to go down. So it's actually a positive thing. But when I read about it, I still thought it's a bit of a silly reason to belong in risk assets here. But it shows you the sentiment was so bearish and everybody was kind of keen to buy the dip and was just waiting for a good argument to do so. And now it was that data point that they picked, and we see a nice little rally there.
So, JP, can it last? And if not, what is needed for it to do so?
Well, that's still the big question. I'm a little bit cautious if it really can last. We have bearish positioning, as I said, and that can drive some rallies over a couple of days or even weeks that we have seen during the summer. But to really endure that rally and to bring a change in sentiment, more importantly, I think we need more data points. We need actually probably some hints from the central banks that they are nearing a point where they are willing to at least ease down on the rate hiking. We want to see inflation coming down. Let's not forget, estimates are still for a brutal move lower in inflation next year. So if those estimates start to be believed, then we could see the rally going a bit longer.
JP, what's your take on Credit Suisse right now? The hot take?
Well, a hot take is the bank is really borderline right now. It's in danger of fully losing the trust of its investors. It needs to make a bold announcement now, not exactly a fast one, but one that has substance, that has a real strategy behind it, and that can reassure the trust in the bank to be profitable in the long term. Because otherwise, there will be in a vicious cycle of losing trust, higher cost of capital, losing clients, losing profitability, and this will go on and on and on. So a bold statement here is needed at the end of the month or earlier.
Great. Thank you so much. JP Barnett there with the very latest on some of these moves. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kaylee Lyons are in New York. Anna Edwards here in London. Now, the focus, not only what we heard from the RBA, but of course, peak expectations for hikes at the Fed. A couple of other things we need to watch out for. A great Kenny Donaldson story saying that Liz Truss will struggle to drive through key parts of the economic revolution she's planning for the UK because her standing in the ruling party is already so damaged. We'll also cross over to Birmingham with our Lizzie Burden. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps will surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are starting to see some companies rip off the earnings mandate.
It's really, I think, important to be forward-looking.
I'm not sure what's normal in today's environment.
We are growing a little bit more nervous about that consensus trade.
It is kind of a bearish opera, and the conclusion is that the opera ain't over until the Fed lady sings a more optimistic tune.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Shock down under. A smaller than expected rate hike from the RBA fuels the debate over whether the end of tightening could possibly be near. Top EU officials raise the possibility of joint debt to tackle the energy crisis, but more hawkish members of the bloc are strongly opposed. We're live in Luxembourg as ministers meet. And Credit Suisse's options go from bad to worse. Investors want to know how the bank will pay for a major restructuring. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, it seems that bad news yesterday on the US markets, on Wall Street, manufacturing in particular in the US. Bad news seems to be good news for risk assets once again.
Yeah, it does. It feeds into the narrative that if the data turns, then central banks won't be quite as hawkish. And the market kind of got confirmation of that from the RBA in Australia overnight, delivering a hike of just 25 basis points. So ending their streak of outsized rate hikes. And that had an impact across asset classes. Of course, you still had China and Hong Kong closed for holidays, but stocks up 3% in Japan, and in Australia up 3.25%. The best day for Australian stocks going all the way back to June of 2020. Where the real impact was, though, was in the bond market. That two-year yield in Australia coming in nearly 32 basis points just in a single day, down to the 314 level. And interestingly, the Aussie dollar was stronger against the US dollar, given that the US dollar seems to be weaker against mostly everything. But as you've seen less hawkishness on the central bank front, it is a weaker Aussie dollar against the US dollar this morning by about 0.2%, trading around the 65-cent level. So one central bank has kind of pulled back the gas pedal, Matt. The question is when all the rest are going to follow.
Yeah, one down, everybody else to go. Nonetheless, market participants are bullish. At least futures are trading higher after the cash trade rose up yesterday. We're looking at a 1.5% gain again in futures. We still have 4.5 hours to the open, but that's a very strong reading for this time. Right now, 10-year yield coming down, so that does mean that investors are buying treasuries. Ray Dalio says cash is no longer trash, and I think that extends probably to the treasuries world, maybe not out to 10 years, but certainly earlier on in the curve. Right now, 357.95 is what you see on the benchmark treasury. And then gold right now, up another 0.5% at 1709 after really a huge rally. I think it was up 2.4% yesterday, which doesn't sound like a lot, but it is a massive rally for gold. Back up over $1,700 at 1709. The Bloomberg Dollar Index is coming down, and you can see that in Bitcoin as well, although it still has yet to pierce the $20,000 mark again. Right now up 1 2/3%, 19,913. We're going to be watching this very closely, Anna, because Kaylee and I have our crypto show today at 1 p.m. this afternoon.
Absolutely. So crypto in focus, no doubt for that reason. Matt, this show should be provided with shades, such as the brightness of the green. For our radio audience, I'll just fill you in that we've got green across the board for European stocks today, up by more than 2% on a number of major markets in Europe. This is a bit yesterday's story because we're following on from what happened in Wall Street yesterday with the worse than expected manufacturing data, sort of reigniting that talk about a Fed pivot. So that is part of the story, but it is also pricing in, as Kaylee says, the narrative from the RBA, one central bank down, others could follow. Is this premature? We will see, but markets certainly running with this story for now. Let us have a look at a deeper dive into other European assets, and this is what we have on the UK 2-year. The 2-year yield once again coming down. We're seeing buying of debt products across the curve, but in particular at the short end in the UK. But this is actually part of a global story more than just what's going on in the UK today. The natural gas price for Europe down by 2.3%. It was actually down by quite a lot more than that earlier on, and that really because of some pretty mild, very lovely weather that we're having in parts of Europe today, and as a result reduces worries at the margin about the winter and gas storage levels. Credit Suisse up by 5.8%. We put this in again today because of the big moves we saw yesterday and then the recovery in the stock. So it was down as much as 12% in session yesterday. Those CDS, the cost of insuring against default, went to a record high. And then we saw those losses in the share price paired. And this was all on the first day of the new CFO at Credit Suisse. So a busy time and a lot to get stuck into, no doubt, over at Credit Suisse. More on that story shortly. Dragscoop, this is interesting. This company is an energy generating business here in the UK. It was down yesterday in anticipation of some negative media coverage around its environmental record. The company has pushed back strongly against that. But actually, today's sell-off is all about whether we will see another U-turn, Matt, from the UK government. They U-turned on the top rate of tax. Will they U-turn on their declaration that they wouldn't put windfall taxes on power-generating businesses, Matt?
Right. Everyone seems to be pushing even harder after they got that first U-turn. Let's get to the RBA's pivot right now. A dovish surprise, it's being called. Australia's central bank ended a streak of 0.5 percentage point hikes, opting instead to raise the cash rate by only 0.25%. 25 basis points to 2.6% in total. Only a quarter of economists that we polled predicted that move. Andrew Ticehurst, a rate strategist at Nomura, says the RBA is clearly dancing to its own tune. So is this a sign that peak rates are near? Let's get more at Bloomberg's Danny Berger. Danny?
I love that idea. Is this just the RBA out on its own? Well, it's certainly not what the market has interpreted because of the impact across global bond markets. But let me first put the size and scope on the Aussie bond move itself. 3-year yields plunged, the biggest intraday fall since 2008. So that just shows you what a surprise this was to this market, but not just a surprise. It is a market where we've just seen carnage to global credit. So it really is a lot of bad news priced in. Any sign of sort of a soft pivot narrative seems to send bonds higher, as we saw yesterday with weaker manufacturing data. So it wasn't just Aussie front-end yields. It was across the globe, from the UK to the US. We really saw this big plunge in bond yields. Even Germany down 13 basis points for the 2-year yield. Again, it is a market, whether it is the economic picture worsening or financial instability that they're hoping will make central banks pivot. This is what the market is pricing. But again, the market is pricing something different than what Fed officials are saying. We heard from Barkin yesterday saying that they need to continue to hike, that this environment is different. Williams saying that they're not yet in restrictive territory. They need to keep going. Even so, we've priced out about 80 basis points of hikes for year-end next year. So what the market is doing and what the Fed is saying are two very different different things right now, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Staying on top of those market moves, let's stay on top of the politics story as well in Europe. European finance ministers are meeting for a second day in Luxembourg with energy taking center stage. The bloc is considering ways to tackle the crisis as Russia cuts gas deliveries and the continent prepares for winter. We spoke with German Finance Minister Christian Lindner.
We have to make efforts to strengthening our common purchase on the international markets. We have to change the order of the electricity markets, but our package is not unproportionate. In fact, it is proportionate.
Bloomberg's European correspondent Maria Tadeo is joining us now from Luxembourg. Maria, you also in the last hour spoke with the French finance minister Bruno Le Maire, who told you he's not talking about common debt issuance, but he's talking of raising money with a guarantee of all states. What was your takeaway from the conversation and what the difference is between those two things?
Yeah, and Kaylee, let's just, because this is very complicated, and there's a lot of jargon in all of this, as it often happens in European discussions. If you go back to the fundamentals, the issue here is that all of these European countries agree that energy prices and bills have to go down, but they do not have the magic formula that works for all of the countries. There has been a number of things happening over the past week. You have the Nord Stream that exploded, and then you have the Germans that came up with a mega package of 200 billion euros to prop up their economies and their households. Now, that has created concerns in the euro area, with a number of countries suggesting behind the scenes that Germany has a fiscal space that other countries do not, and this could create disruptions within the union, but also be a problem for the level playing field across the euro area. And that's where the French come in. They say, we don't want to criticize the German plan. They have a right to defend their domestic economy, but we have to do this in a way that's coordinated. Now, he does not talk openly about joint debt for the time being. What he says is that Europe could come up with a mechanism that could essentially put out loans backed by the EU that could then be reset and provided to different member states. So this is incredibly complex, but going back to the fundamentals, it's the issue that a number of countries have been taken aback by the size of the German package, by the lack of communication from the Germans, but also this idea that come the winter, it cannot be every man to himself.
Okay, and so is there a sense that unity has been rediscovered then, Maria, in Luxembourg, or do they still remain very divided on the extent to which countries should be able to go it alone?
Well, and funnily enough, Anna, I can't tell you the amount of times I've heard the words unity, solidarity, we have to stay together. The sanctions are working because we've done this together, and so far this has been essentially validated by the fact that these decisions are taken unanimously. To me, it was striking today when I spoke to the German finance minister, who was in damage control, telling me there has been a misunderstanding. The package is big, but so is the problem for Germany. Everyone else is doing this, but he was very clear on this idea that I do not see how more debt will fix this problem. So this is a conversation, Anna, that I'm sure will evolve in the next few weeks, and this is not the end of it by any means.
All right, Maria, thanks very much. Maria Tadeo there reporting from the EU finance ministers meeting in Luxembourg. Now let's get back to the banks. Credit Suisse shares trading higher today, just one day after touching a record low. The Swiss lender's credit risk gauge jumped to an all-time high yesterday after the CEO, Ulrich Körner, failed to calm markets on capital levels and liquidity. Stephen Ahrens, Bloomberg's finance reporter, joins us now out of Frankfurt. So, Stephen, how serious is the danger to Credit Suisse?
Well, clearly, the market is extremely nervous. There's a lot of speculation about Credit Suisse. There's even speculation about capital, how much capital will it need to raise for a big restructuring they're planning. The CEO, as you said, he sent out a memo to reassure people. The bank is talking to people to make sure they understand it's in a solid capital position. But again, the uncertainty is really, really big. And there's a lot of uncertainty generally in the market about the macroeconomic environment. So it's a volatile and difficult situation that Credit Suisse will need to manage over the next few weeks.
Yeah, and Stephen, it's still a few weeks, as you say, until we get the details. Meanwhile, the roller coaster ride continues. Stock down substantially, as much as 12% yesterday, jumps back up 5.5% today. What's next to watch?
Yeah, exactly. I mean, it's a roller coaster. And the executives, I mean, you just said it, they have a new CFO who started just yesterday. He came from Deutsche Bank, and he's got, I mean, luckily, he's got good experience managing the CDS price, a volatile CDS price, because he used to be at Deutsche Bank. And so everyone's watching for something to happen, for more guidance on what could come, comfortable with the capital levels of Credit Suisse. And the question is if Credit Suisse will be forced by the market to make an announcement before they actually plan to do so at the end of the month when they present third quarter earnings. The market pressure could become so big that they will have to say something before that.
All right, Bloomberg's Steve Ahrens, thank you so much for your reporting on Credit Suisse. Another company we're watching this morning is Tesla. Kathy Wood's ARK Investment Management bought over 130,000 shares of the electric car maker after they plunged when third quarter deliveries missed expectations. It's the second time ARK has bought the dip in Tesla this year. A few other stocks are moving in pre-market trading as well, as we have Tesla up about 2.7%, and they actually are all also automakers and specifically EV makers. One of them being Rivian Automotive, which of course is another big EV maker. It, after the bell yesterday, reaffirmed its production guidance for the year, expects to make 25,000 vehicles. As a result, that stock is up 7.5% before the bell. You have another EV maker, Lucid Group, higher by more than 2% as well. And then finally, Stellantis getting a bid too, up 3.6%. Matt Miller, Merry Christmas. All car stocks for you this morning.
Thank you so much. That's so kind of you. Anna, what have you gotten me?
Yes. I have you a conversation about the weak dollar. This is more for me than for you, isn't it, given travel plans? But yes, a little bit of weakness in the dollar. We'll talk about that with Kit Dukes. Is it premature? Goes hand in hand with all the risk appetite we're seeing globally today. Kit Dukes joins us from Societe Generale, Chief FX Strategist. And we'll also talk Brazilian politics, the Bolsonaro bump. Perhaps Brazilian equities are soaring after the incumbents better than expected showing in the first round of presidential voting. Is it all about him, or is it about the tack to the middle that both contestants might make? More on that ahead. Plus, waiting for an encore after emerging from the pandemic on top, Pfizer is coming under pressure to produce its next big hit. Read more in today's Big Take story. That's on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here with Kayleigh Lyons in New York, Anna Edwards with us out of London. Now, my heart goes out to anyone who needs to refinance a mortgage in this market, especially in the UK. I don't have such emotional feelings about companies needing to refinance debt as they probably should have done it any time over the last 2 years, but this is still a problem. We're looking at refinancing debt at a cost that's more expensive than it's been in over 22 years. This chart goes back to when I was hired here at Bloomberg, and we've never seen a cost to refinance this high. Priscilla Azevedo-Rocha, Bloomberg's credit reporter, joins us now to talk about what this means for the markets, what this means, Priscilla, for the broader economy, and what it means for companies.
Hi, Matt. Yes, that's right. It has become really expensive to refinance your mortgage, to refinance your bonds. It doesn't matter what type of debt you have now, it has become more expensive. So markets have changed. So that means the companies, they're going to have to rethink what they're going to do when they need to raise finance. Either come to the bond markets at more expensive prices or with higher costs, or look elsewhere for financing.
Good morning to you, Priscilla. And I suppose it's for this reason, because of this blockage that European corporates have run up against, and global corporates to some degree have run up against, that the market got quite so excited about a small pivot perhaps from the RBA. So if the whole world is looking for when are central banks going to pivot away from the laser focus on inflation to, oh yes, growth is actually also a concern, we saw a little bit of evidence of that. Is expectation of this having global relevance, though, is that premature?
It can be a bit premature when we're looking at Europe, because the European Central Bank is way behind other central banks in the hiking path. So there we have a little bit of dissonance. But when we're looking into the Fed and the US, perhaps now the discourse is that they're going to continue hiking. That's at least what economists are expecting in the market. But maybe once that can provide like a little silver lining and the attention turns back to growth.
Okay, Priscilla, so that's what's going on in kind of the macro scale. If we focus on some individual stories, the one that has captured all of our attention over the last 48 hours or so is Credit Suisse. What is going on with CDS today?
Well, CDSs today, they have eased slightly, so they're not rising. So the risk of defaulting from Credit Suisse, they're not as high as they was yesterday. They're still like but this is in line with broader markets. So we need to understand that market sentiment today has improved slightly. There's some better news in the market. So investors are less anxious than they were yesterday. But what we've seen yesterday was a sign of concern. So investors, they're ready to act, and they're showing that they are watching, and they are watching Credit Suisse for the next steps.
Okay, Priscilla, thanks very much. Priscilla Azevedo-Rocha with the latest on credit markets. And for more market analysis, check out MLIV Go. That is the function on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
diplomacy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month. Now Bloomberg's learned he will announce it sooner. He's been under pressure since the tax cuts he announced on September 23rd led to a sell-off in UK assets. The housing market in Manhattan is starting to cool off. Sales of co-ops and condos dropped 3.7% in the third quarter from the previous 3 months, and they were down more than 18% from a year earlier. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. The median price was down more than 7% to a little more than $1.1 million. And New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at a level that would restrict economic growth. He said he expects real GDP to be close to flat this year and grow modestly in 2023. And Matt, I guess that's a signal that the Fed is not anytime soon going to go the way of the RBA with those 25 basis point rate hikes.
Yeah, I don't think you could count on that soon. They've been incredibly vocal about it. Only a couple of Fed governors have talked about the problem of over-tightening, so it doesn't seem like something that's on their minds.
Yeah, and that's exactly the context with which I read the story, thinking about the enthusiasm that the markets have jumped on. Weak data in the US, the RBA not doing 50 but doing 25. It does seem as if investors are still really primed, really looking for those signs of a pivot. And maybe that is premature if, as William says, we're not in anywhere near restrictive or not in restrictive territory. Let us ask Kit Jukes shortly, Societe Generale's chief FX strategist. Does he think the appetite for risk assets we've seen in the past 24 hours has been premature? How much more hiking will the Fed deliver? How much do we need to reflect on the hiking we've already seen and the damage that might have done? We will talk to Kit about all those things shortly. This is Bloomberg.
biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Australia's central bank surprise, a smaller than expected rate hike, fuels the debate over whether the end of tightening could possibly be near. Top EU officials raise the possibility of joint debt to tackle the energy crisis, but more hawkish members of the bloc are strongly opposed. We're live in Luxembourg as ministers meet. And Credit Suisse's options go from bad to worse. Investors want to know how the bank will pay for a major restructuring. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, the market certainly jumping on with enthusiasm. The weakness in the data yesterday for US manufacturing. And of course, we've got plenty of jobs data due this week, really raising questions about whether that sort of bad data impulse continues and how good that could be for risk assets.
Right. Although, you know, we really had some tailwinds behind risk assets even before that data came out. I mean, remember over the weekend, Julian Emanuel from Evercore ISI said, it's time for a bear market rally, and boy, was that great timing from Julian. Take a look at S&P futures. After the big rally that we saw yesterday, we're building on that with a 1.5% gain. Of course, we're still 4 hours away from the market open, and a lot can change. We have seen a lot of volatility in futures ahead of the open over the past few weeks and months, but still a very positive sign. On the other hand, investors are buying the 10-year paper, and they're buying really debt across the curve, so that's pushing yields down about 6 basis points to 357.95. That's maybe good for risk assets. Those rates coming down a little bit. And then gold, after a big strong day yesterday, up 2.5%, it's up another 0.5% today, up over the $1,700 mark as the Bloomberg Dollar Index falls lower. The same is true with Bitcoin. It's had a good day so far, up 1 2/3%, but still not piercing the $20,000 level. So Bitcoin at 19,924. The interesting thing about this is, and we talk about this on the crypto program, we're going to talk about it again today at 1 p.m., is that Bitcoin has held up while most other risk assets in the past few weeks have come down with the pound and with gilt. So it's very interesting to see that this has been a fairly safe haven, as has gold during the mini budget fiasco in the UK. Kaylee, what do you see in terms of the pre-market movers?
Well, there are some crypto-related equities gaining with that move we are seeing in Bitcoin, but you also are really just seeing large gains for large cap technology stocks, including Tesla, which of course had a big down day yesterday after deliveries disappointed for the third quarter. But then Cathie Wood, ARK Investment Management, comes in to buy that dip, and that is helping give a little boost to the shares this morning, up about 2.9% in pre-market trading. But of course, with rates moving lower, yields moving lower, that's really giving a lift to the big tech complex overall. Apple up 1.6%, NVIDIA, the chip maker, by 2.6%. You got Amazon moving to the upside by about 2 percentage points as well, Anna.
Yeah, so yields lower and the dollar a little bit lower, giving room for risk assets to rally. Then, Kaylee, and we had that, as we've said, bad news out of the US and manufacturing sector yesterday. And the European market's just catching up with that story this morning, but also adding in enthusiasm around the RBA. We've talked about it a few times. We'll talk about it shortly with Kit Dukes, but what does it tell us, if anything, about the appetite of other central banks to perhaps pivot from jumbo hikes to something a little bit smaller? The UK two-year yield just sort of indicative of the global story then. We're buying stocks today, also buying government debt, particularly at the short end. We see that, though, the trend is to some degree consistent across the globe. We're seeing it happening in other parts of the world as well. Natural gas prices coming down 2.6% here in Europe. They were down more than that earlier on. Slightly milder weather here in Europe, underlining how things could be better than anticipated for Europe over the winter if that were to continue to be the case. And Drax Group, a power generating business, down by 5.4%. There are questions now being asked if the Conservative Party has pivoted on the top rate of tax, Kaylee. If they're not sticking to that plan to cut that tax rate, then will they also stick to their plan to say that they won't tax in a sort of windfall way the profits of these power generating businesses? So that's certainly something that the market is still thinking about, Kaylee.
Yeah, and let's get other market thoughts now with Kit Dukes, Societe Generale Chief FX Strategist, who is now joining us. Kit, I'm sure Anna's going to want to speak with you about the UK in just a moment. If I could just start in Australia, though, the RBA surprising by delivering just 25 basis points in terms of hikes overnight. That seems to be a pivot from one central bank. Do you read into anything as to whether or not others are going to follow them on that front?
No, I mean, in a sense, the RBA's got a form of wanting to be less hawkish than some. So it's one of those surprises where you look and say, oh, they would do that, wouldn't they? We'll see what the RBNZ does next. But no, I think, look, it's a much more open economy, much more traded economy than the United States. That's a big difference. So they're more affected by what's happening elsewhere, and concerns about the slowdown in China are something they want to watch. So I think they've bought themselves time. They haven't got as much inflation in their economy as some of us have either. So they probably feel they can afford to. And I suspect that's what this is, a temporary slowdown rather than a permanent pivot, if that's the right way to look at it. Because I expect the economy is going to go on doing well.
So, but something has certainly ignited risk appetite over the past 48, 24 hours, Kit. I mean, the weaker dollar, lower rates, this all allowing space for risk assets to rally. Does this look like some sort of bear market rally to you? I know this is slightly away from your FX field, but in terms of the broad sentiment towards risk assets, does this look long-lasting or just a sort of blip?
Lasting long enough to cause some pain to some people, but it's still a bear market rally. Look, I think it's the fourth one we've had this year, to put it in context. The bond market drives everything. So the 10-year note yield has been pushing up. The last correction we had was in June, July. We've had a straight line rise in equities, in bond yields in August, September, that took the dollar up. So took the dollar up in a pretty straight line as well. So sharp move higher in yields. More than 10% rally for the dollar, fall of more than 10% for the S&P, in a pretty straight line that sucked everybody into short euros, long dollars, short sterling, a whole load of trades that all reflect that. And now that we're getting a correction and people talking about, what do we care about the manufacturing data, we're going the other way, and we could go quite sharply. But the thing to look at in the United States, for me, is not the softness in manufacturing that we've seen. The ISM manufacturing numbers unambiguously pretty soft. It's what's happening with the consumer, which is the most important thing over the next few days. So the labor market data matter more. The services ISM matters more. Today's jolts matter more than yesterday's numbers.
Okay.
The consumer is okay as far as I can see.
Okay, so we get the JOLTS data, we get claims data, we get the non-farm payrolls data as we move through the week. Plenty of jobs data points to watch for. Something that has been whipsawed a little bit during September, though, Kit, has been sterling. And I wonder where you think we are on that story right now. We're almost back to levels that we started September at, but not quite. I mean, 113.42 on cable at this point. Where does it head into the end of the year, Kit?
I think it follows the euro now much more. In other words, it becomes less of an independent UK story. I was in Asia last week. I don't take a slide about the UK particularly with me to Asia, and it's all anybody wanted to talk about for a number of days. Completely sort of everybody trading it, and I think everybody short of it. And I think that move is finished. So I think euro sterling is now going to be settling into a range. The determinant of what happens to cable over the rest of this year is more than anything else going to be what happens to the dollar broadly, but what happens to euro dollar. If it's a cold winter, the euro and the pound are both going to suffer from concerns about blackouts. If we escalate the war in Ukraine, that makes things worse. If that quietens down, it gets a little bit better. Those are the drivers of sterling, and possibly we won't have to talk as much about Liz Truss and Kwasi Kwarteng for the rest of the year.
What about the U.S. dollar, Kit? I mean, we're heading in to midterms right now. We're starting to see things change, as the surveys pointed out yesterday. I heard from Tim Fiore that over the past few months, there have been 8 times more companies looking to hire than looking to freeze or reduce labor. Now it's 2 times more companies looking to hire than to freeze or reduce labor. So is there any bear case for the U.S. dollar here?
That it's really, really expensive. So the short-term bear case is pretty clear. We've come an enormously long way. But it's hard to believe that we've seen the highs or the end of this move when household balance sheets are healthy, when the tightness of the labor market is going to keep upward pressure on inflation as it spreads through more bits of the economy, so it won't come down enough, and where the Fed, frankly, having not had to fight inflation for very many years and having got itself a little bit behind the gain line in that fight, is going to be terrified of pivoting too early. So I suspect that if we see any signs of anything still strong in the labor market data and so on, that the Fed's going to reaffirm its commitment to make sure it defeats inflation, even if the economy has to slow. I think that makes it a really tall order to say, yep, this is the moment the dollar has peaked. I think it will peak in the fourth quarter of this year, but I think I would certainly want to take a view on the U.S. economy off the household sector and consumption rather than off particularly manufacturing, particularly the international facing sectors.
Okay, so the dollar peaks this quarter, and we look for clues in the consumer. Kit, thanks so much for your time. Kit Hughes of Societe Generale, great to speak to you today. Coming up, we'll turn to Brazilian assets. Brazil's bump assets are soaring after Bolsonaro's better than expected showing. More next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayleigh Lyons in New York and Anna Edwards in London. Now, Brazilian assets are getting a boost after incumbent Jair Bolsonaro secured his way to a runoff election against Luiz Inácio Lula da Silva. Investors cheered on Bolsonaro's better-than-expected showing and bet his challenger Lula would be forced to moderate his stance in the second stretch of the race. Clara Ferreira-Marquez, Bloomberg opinion columnist, joins us now for more. So, Clara, it looks like investors want Bolsonaro to do well, or do they just want Lula to be less left?
Well, I think it's a bit of both. They definitely would like to see the pursuing of some of the reform agenda that we saw promised by Bolsonaro, certainly in 2018 when he first came to power and when Finance Minister Paulo Guedes was really selling this to investors, so fiscal reform, a lot of things that he didn't actually push through. And then we have on the left, with the PT and Lula, really investors wanting to see him push to the center. Now, it has to be said, this really has been where he's positioned himself since the start of the race, and we know from his track record that he's a pragmatist. He governs from the center, but of course he hasn't provided a lot of details, so it'll be interesting to see what these assets do as more of his agenda, more of his plan for governing becomes clear.
So what should we expect to see over the next 4 weeks?
Well, a lot more detail from Lula, a lot more vitriol, a lot more violence as well, which will create some instability, but certainly a lot of action. So far from both sides, in fact, we've seen a lot of personal attacks, but not a lot of macroeconomic detail. In fact, they don't really differ on the macroeconomy. It's more on issues like what to do with state enterprises. So it'll be really interesting to see a bit more detail from both sides.
Yeah, they also differ on what to do about the environment, don't they, Clara? Some insight there, perhaps, as to how much that's become an issue, because it's written about from outside Brazil a lot. I wonder how much it's really at stake here.
It's actually not it's not been an issue, surprisingly and disappointingly, for the Brazilian electorate. Really, this is an election that is all about the economy. It's all about high inflation, squeezed incomes, hunger. It hasn't been about the environment, though, of course, both there and during the pandemic, Bolsonaro's record is abysmal.
Clara, thanks very much. Thanks for joining us. Bloomberg Opinions, Clara Ferreira-Marquez talking to us about the latest on Brazil. Let's jump from Brazil to the UK. Some members of Liz Truss's top team say the UK Prime Minister will struggle to drive through key economic policies because her credibility is already so damaged. Mel Stride, Conservative MP and Treasury Select Committee Chair, spoke to Bloomberg's Lizzie Burden earlier today.
Under current economic circumstances and given all the spending issues that are in play, undoubtedly it's going to be quite a bumpy road. But I think we need to not put the cart before the horse. I think we need to just settle things down now and take a measured view going forward as these issues arise.
Mel Stride there, somebody who's been calling very loudly for more cooperation between the government and the OBR, that body we mention a lot. Now, our markets editor, Valerie Teitel, joins us and has been looking at UK assets and how they've been responding of late. Valerie, is there a sigh of relief in UK assets? And if there is it to do with the politics, or is it about changing expectations around the Bank of England?
Yeah, thanks, Anna. I want to present a view that the rally that we're seeing in sterling, it crossed the 114 handle earlier this morning, but that rally we're seeing in UK assets is less about the U-turn happening in politics. It's what happened with the Bank of England purchases yesterday. This is their 4th day of purchases, and they only bought 22 million of one single bond. Now, the other side of this is they rejected 2 billion worth of bids. Now, how did the market handle that? It was a test of the market depth, and 30-year yields handled it very well. They only traded weaker on the day by 6 basis points. That shows that maybe the fire sale on gilts is very, very over at the moment.
So, yeah, the fire sale that kind of didn't happen or only happened before they stepped in. What does this mean for the BOE? What does this mean for, the next few weeks in the markets?
Yeah, look, a big sigh of relief at least. We know that now that the Bank of England is less likely to unwind an entire year's worth of QT by these 2 weeks of purchasing operations. But look, the big picture is the less the Bank of England needed to buy, the less stimulus they were going to add into the economy, and the less aggressive in hikes it needs to moving forward to undo it. The hike expectations for the November MPC meeting are now down to near 100 basis points. They traded up to a high of 180 last week. Even the terminal rate for the Bank of England has dropped nearly 100 basis points to 5.4%.
But look, this bodes well for the BOE's fight against inflation, that it can do so without hiking rates too high, without causing more jitters to the UK's mortgage market. But big picture, it's looking more and more likely that the Bank of England can save face doing this liquidity operation in the midst of a tightening cycle. Look, because it's not too far-flung to say that the ECB is going to have to fight the same thing in BTPs, and hey, maybe even the Fed. We know that Treasury liquidity conditions have been deteriorating rapidly. It bodes well for these three big central banks that maybe liquidity operations in the midst of a tightening cycle is something they can get away with.
Okay, yeah, that's really interesting, isn't it? Because it did raise a few eyebrows as to whether different parts of the Bank of England machinery were operating in different directions. Valerie, thanks very much. Bloomberg's Valerie Teitel on UK assets. Coming up on this program, Elon Musk's plan for peace. The Tesla CEO setting off uproar after tweeting his thoughts on Ukraine. More next. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, Tesla boss Elon Musk is under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. He also called on Kiev to give up Crimea for good. For more on this, we're joined by Bloomberg's Craig Trudell. And Craig, you come at this, of course, not from the geopolitics, perhaps, but what this means for Musk as somebody who sells cars globally, the Tesla business owner. So Musk has previously obviously shown acts of goodwill towards Ukraine, and even in this series of tweets has said, yes, of course we support Ukraine, look at what we're doing on satellite connectivity. But this latest series of tweets has not gone down well in Ukraine. What do you think it means?
Right, it's not been well received, and you referred to the idea that he's been supportive of Ukraine, not only with Starlink, the satellite internet service, but also sending solar packs and generators soon after Russia invaded. On the other hand, I think there is a sort of view in Ukraine of we already voted on whether or not we want to be independent way back in 1991. We don't need this suggestion for a new vote. Set aside the idea that many people have died, many people have been displaced. So there's definitely a lot of sort of anger, as you put it, ill will reacting to this. And some viewed those acts of goodwill of sending the generators and the satellites and whatnot as just that. Others kind of do look at this a little bit askance and say, hey, this guy has talked about sending ventilators during the pandemic, and he sent CPAP machines. He tried to build a submarine for the Thai cave rescue back in 2018. That ended up being a little bit of a stunt. Is he really just kind of fishing for attention and trying to insert himself into a disaster over and over again? And well, is this really sort of goodwill?
On the other hand, I mean, sure, if you tell someone who's vowed to fight to the death not to do that, they're going to be angry. Especially after they've given up so much already in that fight. But isn't there room at least for one or two pragmatic views out there? I mean, he is saying in his tweets that he's just trying to save lives in the long run. He's just doing the math, right? Because Russia is very large and has a lot of nuclear weapons.
Right, and that's really what Musk's point is here, Matt, to your point, is he's after trying to end this. I think the controversy here is his suggestions for solutions, what he's kind of leaving out, what he's overlooking. And certainly I think there's a case to be made that others share his view that the fact that Ukraine is having some success defending itself potentially prolongs this conflict, leads to more death. And certainly there are people who, understand where he's coming from here. I think, it's really just a case that there are some people on the other side of that debate who really have strong feelings, easily get animated, and for understandable reasons here.
Yeah, and does that mean that those people are not going to be interested in purchasing Teslas because they're affiliated with Elon Musk? Craig Trudell, thank you so much, our global auto czar. Thank you for joining us. Now let's take a quick look at what is ahead today and what is on the agenda. The World Aviation Festival, billed as one of the most important aviation technology conferences, will get underway in Amsterdam. You also have the Warsaw Security Forum starting in Poland. It will run through Wednesday, as several European leaders are expected to speak, including German Foreign Minister Annalena Baerbock. ECB Governing Council member Mario Centeno will be speaking at a conference in Luxembourg at 8:30 a.m. New York time. Then in Fed Speak, John Williams, Loretta Mester, and other regional Fed presidents will be talking at various events. And finally, we'll get some U.S. economic data as well, including factory orders and durable goods orders. And my question, Matt, will be if those come in strong, does that sap risk appetite, as we have seen bad news actually being good news for the market, or will that data come in softer and kind of reinforce the idea the market has gotten in its head over the last 24 hours?
Yeah, I think, we're going to see data points coming in either direction, and maybe the market reacts on a dime, or maybe they take a longer term view, and this is just a bear market rally that's destined to run its course. It'll be interesting to watch when that data comes out.
Yeah, I spoke to one strategist from SEB earlier who described it exactly that, as a bear market rally. And certainly Kit Jukes was telling us the focus on consumer and therefore on jobs is important. That's it for the early edition. More surveillance is ahead. We will be back. This is Bloomberg.
as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
The big issue here is, does the Fed get the kind of controlled moderation in labor markets and growth?
We just haven't seen that rise in the unemployment just yet.
We are starting to see some companies rip off the earnings mandate.
Markups are insanely high everywhere. People have been gouging prices for any goods.
I think what's breaking is the soaring dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This is the 10th edition of Peak Bond Yields, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK, how many times have we done this? We're doing it again.
We're doing it again in June, and of course we see it, the Dow up 1,200 points or whatever, and you see it, they're leading the way maybe, and the NASDAQ coming up too. But John, I've got to go around the globe from Sydney to Perth this morning. Shock. And how do you link in this bond rally you're talking about with the shock from the Bank of Australia?
If they go 25 basis points
blink
instead of 50. Is that a blink?
That's a blink. That's an official blink.
That's not a blink. That's just basically saying that perhaps we're closer to peak yields, right? I mean, that's basically, is that a blink? Does that count as a blink, maybe?
They blinked in Perth. They did not blink in Sydney.
Okay, but here's the question. Does this symbolize that central bankers around the world are hitting the thresholds for how much they can tighten policy in the face of financial stability risks, even as all that Fed speak, which I ignored yesterday, but still was there, basically came out and said, we're not going to blink, we're going to keep going, we have considerably more to go before we get to a tighter policy.
Well, let's go through the numbers and talk about where we are now relative to where we were a week ago. The 2-year was 4.35 last Monday. Right now it's about 4%. The 10-year was a little north of 4% last Wednesday. Right now the 10-year is 3.58. So you fold that into this discussion about the RBA, and you've got this broader story that we've seen peak bond yields. Again, we've done this about 5 different times this year.
We are data dependent into the fourth quarter in every way, shape, or form, including earnings, I believe, October 14th. But, John, mostly what we are is data dependent out to Friday.
So I would pick up on the data point as well. Let's say we have seen peak bond yields. Is that bullish? Is that bullish if we've seen peak bond yields and the weak data is still in our future, the weak earnings is still just around the corner?
Mike Wilson says no. Mohamed El-Arian says no. Many people say no, which is the reason why people are watching this story play out again of the pivot, the imminent pivot that has to happen from the Fed, that has to happen from the ECB. Take a look at European bond yields. Wow, they absolutely crashed yesterday. And people are saying, you guys are ridiculous. This is not what they're going to do.
Can we pick up on sterling just briefly?
Please.
6 days of sterling strength.
You always want to do sterling.
103.50 last Monday. 114 this morning. I think it's worth picking up, given the weakness we saw last last week.
You brought props yesterday. Come on.
I know. You brought a flat cap.
I know. So you want to talk about sterling just as much as anyone else.
Yes, that's true. But I would say John's right about the move. John, honestly, I've never seen anything like what we're seeing from the daring two of the trust government.
It's unreal.
Honestly, I'm like everybody else. I'm on my phone. To be honest, I go to the Telegraph and to Bloomberg's great coverage, and I go, you got to be kidding me.
There's now a conversation about maybe moving the budget forward and moving
from
it
November, whatever.
Moving it in so it's before the Bank of England rate decision. I mean, that would be the logical decision here, to allow the Bank of England to come up with some accurate forecasts relative to what they've heard from the fiscal side of things.
The problem is, how did they bungle this so bad?
Sure.
Why did they rush this out if they knew that there was going to be some pushback? And isn't this basically just a comment to, we messed up, but we're not going to say we messed up, and it really reduces the confidence in this administration.
Have we got some time for Ray Dalio a little bit later?
Yeah.
The cash is no longer trash.
It's not. Yeah.
We're seeing capitulation across the board here,
Across
aren't
the
we?
board. Well, do you consider that Marco Kalanovic capitulation as well?
I mean, for Marco, I think so. It was about that close to just
seriously?
saying I was wrong. If you're going to say my price targets are at risk of being achieved in 2023, then they're no longer your price targets, are they?
I would look at Swiss franc as a real litmus paper, this entire debate. Seriously, from Australia to Washington, from what's the capital of Australia, Perth?
No, Tom. I'm pretty sure it's Canberra.
Canberra. Is that how you pronounce it?
I think so.
Canberra. Canberra to Washington, it's all the same. It's all the same. It's just about the data. And it's a fascinating debate, a la what Mr. Dalio said. We'll talk
Australians will love us this morning, that's for sure.
They do, I'm nailing it.
I'll whip through the price action for you on the S&P 500. Futures are positive after a big day of gains yesterday on the S&P. This morning, up by 1.6%. We're positive 59 points. Yields lower by 6 basis points, 358 on a 10-year. As I said last week on a 10-year, a little north of 4%, Tom. We've come all the way back down.
And what I look at as a real yield, the inflation is just, look for the program, folks, on Friday. It comes in from a 1.60 to 1.38, a lower inflation adjusted yield. And John, you do that with the Bloomberg Financial Conditions Index improving today. It's less restricted.
A dollar weakness at the epicenter of that, I would argue, Tom. 5 straight days of dollar weakness. Euro dollar, Lisa, 98.82.
Yeah, right now we're also looking at a whole host of Fed speak. We didn't do it yesterday. Today it's going to matter quite a bit. We've got Fed speakers, including Dallas Fed President Lori Logan and New York Fed President John Williams at 9 a.m. I just want to point out, John Williams spoke yesterday, basically coming out saying, we're not going to pivot, guys. Stop it. Just stop it. And the market said, haha, just kidding. So we'll see whether he reiterates that today. Cleveland Fed President Loretta Mester at 9:15. Fed Governor Philip Jefferson at 11:45 a.m. And San Francisco Fed President Mary Daly at 1 p.m. Yesterday, we saw the biggest one-day decline in 10-year Treasury real yields going back to March of 2020. There was a complete reset because people are not buying what these officials are saying, which is that they can still need to raise rates considerably, and they are going to stay the course until they see material change in the labor market, among other things. Talking of the labor market, 10 a.m., we get U.S. August JOLTS job openings data. This is key. Arguably, watch the data, Tom, you're saying? This is what I'm watching because you're looking for some sort of loosening up in the labor market, which we haven't really seen. I mean, yesterday, or the last time that we got job openings data, we actually saw an increase, not decrease. Companies were advertising for more people, raising questions about whether the labor market has fundamentally changed and companies are going to hang on to their workers for longer because of what happened during the pandemic and because of the worker shortage that they still actually do face. And at 11 a.m., we hear from ECB President Christine Lagarde. She's going to speak alongside President of the European Central Bank to Cyprus ahead of a European Central Bank meeting over the next couple of days. How much they address this belief in a pivot? Do they come out and they say, look, we still have considerably more to go. We're going to keep raising rates. Oh, and by the way, we see the chance of recession as more likely. John, how much is that projection of a no recession scenario as a base case for Europe part of what's giving people confidence in this pivot story? Because if they're not recognizing reality, then they're not weighing the political ramifications of hiking into more dramatic weakness.
Elisa, thank you. I think the ECB is the only group out there right now not forecasting a recession in the Eurozone.
Seriously.
TK, pretty much everyone else is forecasting exactly that, recession in Europe.
I do want to go back to this, as Europe is the focal point. The war is in Europe. Lagarde, all of the institutions there have to face this. We underestimate, particularly off the furor yesterday of the Jeff Sachs interview, we underestimate the emotion right now of this.
Let's get to the market conversation with Ben Laidler, global market strategist at eToro. Ben, in your work, we see some hope this bond rout may be easing. This is a key ingredient for any equity recovery. Before we get to talking about whether this is positive or not for risk assets, can you tell me why you think bond yields may well be peaking this time?
I think it's difficult to see real yields just continuing to head to the moon at a time when all your inflation lead indicators are rolling over, where recession risks are spiking. I think the disconnect is in there, and I think given where real and nominal yields got to, and on the flip side, given where valuations and sentiment have got to, I think that risk-reward setup is very, very interesting.
Ben, given that, if the Fed is going to retrace some of its pretty hawkish statements, what does that mean in terms of earnings? We've heard this from Mike Wilson. We've heard this from Mohamed El-Erian, that be careful what you wish for, because if the Fed does retrace, that means that things are really bad and we have not priced that in.
I think this is, to your earlier comment, this feels a little bit like Groundhog Day, right? I think the setup is very similar to where we were before the big sort of June rally. I think the market is sniffing out the sort of top of the Fed cycle. I think bond yields have overshot and are now coming down. And I think, to your point on earnings, we're going into third quarter earnings season where, yet again, expectations are very, very negative.
Yeah.
And I think this is an attractive setup. I think we're just going to leap over this sort of low bar and breathe a little bit of a sigh of relief.
Ben, I want to go to your huge track record on 3 cycles of getting the market right. And I want to go to Lisa's gloom yesterday. I want to go to nodes of revenue guesses. What it comes down to is, with a slowing economy, everybody's going to try to guess revenues at the top line. Given all the economic mumbo, John, what are the nodes of revenue guesses going to do?
I think this is all sort of fear versus reality. I think markets, we're down 25%. Earnings expectations have actually fallen quite a lot, I would argue. And not all recessions are created equal. I mean, granted, we're almost certainly going into a recession, at least outside of Asia. But this is not 2007. This is not 2020. This is, I think, a much more plain vanilla, central bank-driven recession. And I think that is, given where we are, I think that's actually pretty investable. That's a 2 percentage point GDP peak to trough fall. That's a 14% decline in earnings expectations, where I think you're at least halfway there. Again, I think where markets and sentiment and valuations are at this point, I think the bigger risk is being out, is being out, not in.
Okay, so Ben, given all of that, just quickly here, how much are you buying with your conviction? I mean, basically, are you loading up the truck?
I think we're building a bottom, right? I think this is a U-shaped recovery, not a V. I think the Fed has told us quite clearly that, they're going to stay the course until something breaks. Well, hey, stuff may be starting to break. We don't need the top of the Fed cycle. We just need a little bit of visibility that it may be coming in the next sort of 4 or 5 months, and the Fed's just not going to keep hiking here. I think all the lead indicators are telling that. So I'm comfortable enough saying we're building a bottom, so I'm fully invested. I'm certainly tilted a bit more to the defensives. Risks are still pretty high, but I'm absolutely nibbling at that sort of quality risk, that sort of big tech, discounted small caps. I mean, the more this goes on, the closer we get to inflation definitively coming down. I think you're raising the risk budget into that.
Ben Laidler, thank you, sir, of eToro. Defiantly bullish on this equity market, with equity futures this morning going in his direction, Lisa, around 1.65% on the S&P.
It says everything that you have to say defiantly bullish, because it's so rare.
It's been a tough year, right?
I know, but defiantly bullish at a time when a lot of people are saying that even a pivot isn't going to necessarily do the trick.
I want to quantify your opening, John, about the market lift we're seeing. The Bloomberg Total Return Index, the Full Faith and Credit All-In Index, it's up 1.56% in price.
We'll take that.
It's a launch.
Tom, we'll take that after the brutal year we've had so far. Brutal, my favourite word. Nodes are your favourite.
Oh, yeah, love nodes.
Right? Yeah, love that. Love brutal. Nothing brutal about this screen, though. Brutal for bears, maybe, as a one-off. Futures up by 1.6% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month. Now, Bloomberg's learned Kwarteng will announce it sooner. He's been under pressure since the tax cuts he announced September 23rd led to a sell-off in UK assets. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea fired a missile that flew over Japan. Now, that prompted a rare public safety warning from Tokyo. The missile splashed down in the Western Pacific, about 2,000 miles east of Japan. Former Meta Platforms Chief Operating Officer Sheryl Sandberg is donating $3 million to the ACLU for the fight for abortion rights. The organization says Sandberg's donation will give it a running start against state anti-abortion efforts spurred by the Supreme Court's overturning of Roe v. Wade. Bloomberg estimates Sandberg is worth $2.1 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, Friday on Bloomberg Television and Radio.
Becoming a distraction, so that's why we immediately changed that policy, and that's the kind of government we are. We do respond when there are concerns, and we act quickly.
The British Prime Minister Liz Truss there earlier today from New York City this morning. Good morning. Sterling stronger for a sixth straight session. We've gone from 103.50 last week through 114 on cable just this morning. Elsewhere, futures positive 1.8%, a lift again in this market. Futures positive with yields taking a dive lower by another 7 basis points on a 10-year, Tom. 356.96.
So moving very exciting into a raft of labor report that will pick up, I believe, on Wednesday, ADP, and on we go to the jobs report on Friday. John, I saw a movie, the Queen movie kind of thing, over the weekend, and there it was, 1945, and I wonder if this Conservative Party, where they adore Churchill, and the certitude in the movie that Churchill would win in 1945, war hero and all that.
Sure.
And he got crushed by Clement Attlee. You wonder if we're going to redux that here.
There has to be space for a government to make a decision to change course if they want to. And they're clearly changing course after the pressure of the last couple of weeks. Joining us now is Bloomberg's Lizzie Burden in Birmingham in the UK. Lizzie, you're at the Conservative Party conference. There's now a conversation about whether the budget that was penciled in for the end of November actually takes place before the next Bank of England decision. What are people telling you about that?
Well, we don't have a date yet. There are rumours that it could be this month, speaking to MPs around the conference hall. And as you say, it would be ideally before November the 3rd so that the Monetary Policy Committee could take it into account. And it's not just what the government says that's important, it's also what the Office for Budget Responsibility, the fiscal watchdog, says, how much all of this is going to cost, how much growth it's going to create. Is the OBR less optimistic than the Chancellor about that? Because, of course, it was the absence of an OBR forecast from accompanying the budget in the first place that seemed to partly be the reason why the budget was undermined in the eyes of the markets. So this is the U-turn for the markets. The U-turn for the consumer, for the voter, was the U-turn on the top rate of income tax.
Lizzie, on sterling, 103 to 113, is the feeling in Birmingham that it's all clear?
Well, I say that the bringing forward of the OBR forecast is for the markets. There remains the massive concern that you've got this huge package of tax cuts, and even the government admits that the top rate of income tax that they've now reversed was merely the tip of the iceberg, remains uncosted, unfunded, and it's not an emergency measure like the energy bailout. These are permanent, effectively, and this is, of course, what originally offended the markets. So are we going to see more reversals on these? It seems like it's open season now. Liz Truss has been bullied on the top rate of income tax by her own party. Remember, she wasn't even the pick of Tory MPs to be the leader. Are there going to be more reversals? Markets perhaps are taking a bit of comfort from the fact that this government seems to be a little bit more malleable than we thought from Liz Truss versus Margaret Thatcher impressions in the first place.
Well, but Lizzie, to that point, is she actually less popular among her own party? In other words, does she have less power and less credibility in response to the U-turn, in response to her malleability by markets, by other conservative members who pushed back?
I have to say there seems to have been a change of winds since yesterday. Yesterday, we were hearing that MPs were writing to the chair of the 1922 Committee of Conservative Backbenchers to try and remove this one-year immunity that Liz Truss has from a vote of confidence. That seems to have died down, but what my colleague Kitty Donaldson has reported, she's been lurking in the dark corners of the conference hall, is that even cabinet ministers are worried that Liz Truss is just going to be a lame duck for the rest of her premiership. And it's the first U-turn was the top rate of tax. Now we're going to see Liz Truss pushed around by Tory MPs on planning reform, on the cap on bankers' bonuses, and actually she may not be able to materialise her plan for economic reform. And if she can't do that, if she can't boost growth, then how are they going to win the 2024 election?
It's going to be a hard time, that's for sure. Lizzie, wonderful coverage in the last couple of days. Lizzie Burden, they're over in Birmingham, England, covering the Conservative Party conference. The government, Tom, under Liz Truss, not even a month old, and we're already having this conversation about maybe this is the beginning of the end.
Explain this to us. I mean, I go back to Wars of the Roses, and I think it was the 14th or 15th century as well. Nothing's changed, has it?
I don't think much has changed, Tom.
Nothing has changed.
I mean, how many times have we seen this movie play out in the last 5 years? Never mind the last several
Well,
centuries.
let's take a given junior cabinet member in trust. They get the big lift up there in 10 Downing Street.
Sure.
They're in the room. And then this.
All of a sudden, and the approach is changing. Let's be clear about scrapping the top rate cut that they were looking at, and now they've delivered a U-turn. It's 2 billion sterling out of 45 billion in tax cuts. It's tiny. The approach is the bigger point here. The approach has changed, but that's domestic UK politics. I think the issue across Europe is much bigger than that. The initial plan to cap energy bills, that was the big one. That was a lot of money, unfunded, uncapped liability, and then Germany's joined in too. And the controversy in Europe, for me now, at least for this week, is far more interesting than the drama, the soap opera playing out in the UK.
Especially because nations in the Euro region are angry that they didn't have a better sense before Germany announced their fiscal spending plan of what they were going to be doing. This affects borrowing costs around the entire region. This affects the ECB's ability to tamp down inflation, and it affects their ability to really plan to figure out the other nations of what they want to do. But really, at the heart of this, how much slack is this bond market giving to fiscal policymakers to actually go forward with some of these plans?
Isn't the heart of the matter, John, and I don't mean your place in Notting Hill, but, you know, like 3 or 4 streets over where somebody's got 5,000 to 6,000 square feet, they get the same heating bargain that someone in the Midlands has.
The unit cost. The unit cost. They're trying to cap the unit cost.
To Americans, this is unimaginable.
So they're trying to cap the unit cost and therefore cap the overall average bill. I think it's been miscommunicated over the last month or so, but you're capping the unit cost. So if you consume more energy, Tom, you will have a bigger bill than someone who consumes less.
Okay.
You'll just be charged a unit cost that has been capped by this government. Okay. Did that make sense?
I'm learning every day.
Well, the problem is that ultimately this comes back to how do you dampen demand? Because ultimately, if you don't, then you're getting yourself into some sort of downward cycle where you're bailing yourself out only to have a bigger hurdle to bail out, right? I mean, that's essentially what the fear is. But it's not just the United Kingdom. And we were talking about how this is an idiosyncratic story. You had the IMF come out with that pretty shocking statement saying this isn't really responsible. But they're not alone when it comes to fiscal spending right now.
A headline out 20 minutes ago, I guess.
Sure, where from?
Kremlin. Quite positive, that's our language, quite positive that Elon Musk seeking peace in Ukraine. I didn't know whether to mention it or not. I wasn't sure it was a real headline.
You've got 15 seconds to explain it. Do you think you can in 15 seconds?
No, I can't.
I don't think I can either.
I looked at it and said, really? I didn't trust it.
Futures up by 1.8% on the S&P. Live from New York, this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City, equities looking good here on the S&P 500, pushing higher by 1.8% on the S&P. Equities up across the board yesterday on the S&P 500, the biggest one-day pop since July. We had some weight to it on the Nasdaq 100, futures up by more than 2%. The why? You'll find it in the bond market. Yields lower aggressively so yesterday on a 2-year down 17 basis points on the session. This morning, yields lower again by 11 basis points on a 2-year to around about 4%. So we're way off the highs of last week, pushing 4.35. So yields lower, equities up, and guess what? Dollar weaker, sterling positive once again. Sterling climbing from 103.50 a week ago Monday morning through 114 today at one point. Tom, 113.63.
Is the crisis over?
Cable up a third of 1%. More to go. I think we've still got more to go. I'm not saying you're going to have the kind of volatility you had a week ago, but we've still got some issues to settle. And I think that's the bigger point.
And to watch the bond market maybe more than the easy-to-watch foreign exchange market will give you some of that perspective along the way. Right now, she has one of the greatest parchment streams in the United Kingdom, from Edinburgh to London School of Economics, with real expertise on China. The chief economist, T.S. Lombard. Freya Bamish joins us right now. Freya, just to start, are we in global recession?
I think we're heading that way. I don't think we're quite there in the US. China's probably coming out of its recession, but still very weak and not really going to get its reopening boost until H1 of next year. The real problem is Europe, and I think this is what's moving markets at the moment as well. That there's something much wider going on here than just the kind of the if I can use the term slightly candid delivery of the fiscal policy response in the UK.
I looked for you at the news flow, and clearly Australia blinking is important. What are the ramifications for other central banks, including ECB, that RBA just decides enough?
Yeah, I think what's happening here is that there's a global shift towards a higher returns environment, but you can't get there all in one go. The real economy just can't handle it, and there are these sort of powder kegs of financial accelerators that have been left behind by the period of low yields in the 2010s. So trying to get from the 2010s level of yields to a pre-global financial crisis level of yields, which is where we think we ultimately will be ending up over the 2020s. Trying to do that in one mini cycle, which is the COVID cycle, is just too much for the real economy and for financial markets. So I think what we start to see now is that QE comes back in a very different guise from how it did in the 2010s. It's much more of the sort of the Badger response to try to provide liquidity where necessary in order to prevent yields from rising more rapidly, rather than to try to keep yields from shifting lower. And I think the underlying forces here are much wider than the kind of the narrative, at least around the UK suggests. What's happening here is that there's been a redirection of funds in favor of the energy firms, in favor of Russia, really, and the non-fossil fuel firms. And what that does is you're handing funds to companies and countries that are much more likely to want to invest them than they were in the recipients of those funds in the 2010s.
Well, Freya,
and in that process, you're dragging yields higher.
There's a lot there, and I want to just hone in on one thing that you said. That quantitative easing this time around is going to look very different. Does that mean that you think that quantitative tightening's over and then we're entering a new quantitative easing cycle of trying to reduce the pace of bond yield increases?
I think as far as the UK goes, yes, I would say that quantitative easing is sort of dead before it gets off the ground.
Quantitative tightening.
Quantitative tightening. Thank you. The quantitative tightening just doesn't really get off the ground. That you get this kind of QE that is not the same flavor as the 2010s, and it's there to prevent yields from rising too rapidly. And that is probably the case for Europe as well, where we're, if anything, more worried than we are about the UK, with Germany already having suggested that they're going to go it alone on the fiscal front. Where does that leave countries like Italy, where we'd be much more worried about those kind of structural issues starting to re-arise in the euro area? Therefore, you get the move back to the TPI, which can very easily translate into something similar to what the Bank of England is doing with regards to its kind of short-term new flavor QE. So it's a very different flavor of monetary policy since the 2010s.
How much is this a European story and how much is this a global story? I mean, Tom was talking about the RBA blinking, raising just 25 basis points rather than a bigger rate hike that was expected overnight. How much is this the example rather than a story of specific nations facing specific inflationary pressures?
I think there are now so many different idiosyncratic problems that are arising at the same time that we can say that something systemic is actually going on. The European trouble, Europe is definitely at the center of this. I would definitely point out problems in China that can arise perhaps not till after the reopening, so therefore into the second half of next year. But I would definitely point that out as structural turning points for China as well. And I think because of this kind of updraw in yields that fiscal authorities are very much leaning against, you've got this battle for funds that really speaks to the longer term secular trends that have just been sort of fast forwarded by this energy shock, that deterioration of the geopolitical environment and the natural environment. These are all factors that are kind of nasty cost push inflation factors that speak to the need for higher returns and the likelihood of higher returns in the 2020s. And we're just seeing the fast forwarding of that in the short term. But I think it does lead to capitulation from central banks, first in the form of pushing back against the financial accelerators, as we've seen in the UK in the pension funds fiasco. But then in the case of Europe, as a result of the slowdown in growth, yes, governments are supporting their economies through fiscal spending, but the cost of doing that, there's no free lunch. The cost of doing that is that yields are much higher. So you're getting the spending on energy, but it's happening at a higher yields, and therefore the property market in the UK and yields more broadly are starting to tighten financial conditions and tamp down on growth in that fashion. So central banks turn from worrying about inflation in Europe to worrying about the financial accelerators and then growth. And therefore you get the capitulation in that sense. I think in the US we are in a very different position here because inflation is more embedded, and therefore the policy response has to be still focused on inflation.
And this is the heritage of T.S. Lombard, Freya. I mean, model out how they get to 2%, given that a huge body of people say that's an impossible event. Do you just assume they get to 5% or 4% and then recalibrate?
I think that's probably where we're getting to further down the line, that they will eventually explicitly or implicitly revert inflation targets higher, just because there are so many secular forces that are pointing in favor of higher inflation, and not all of them being kind of cost push inflation. There's also this change in the relationship in global labor markets and credit as well that suggests that China is no longer a cap on wage growth in developed markets. Therefore, you have faster wage growth. You also have faster credit growth, and both of those things are inflationary. So leaning against that means you're kind of accepting this politically unacceptable idea of a much higher unemployment rate in order to get inflation back down again. But I think in the shorter term with the Fed, the point that I would get across is that there's too much reliance on leading indicators that are simply monitoring what the costs are doing, and that the demand-supply imbalance in the U.S., both in terms of the goods market still, both in terms of the labor market, is still great enough that you've got this underlying heat in demand in the economy. And therefore, while the rest of the world has good prospects for a slowdown in inflation, I'm still worried that you get upside surprises in inflation in the U.S. because margins have greater room to expand on the back of demand still remaining relatively strong. So we're very much looking out for that U.S. recession coming through, because that's the kind of the key turning point for the Fed. But it doesn't seem like we're quite there yet.
Fred, thank you for being with us this morning. Fred Beamish of TS Lombard, just absolutely brilliant. And Tom, I'm so pleased you brought up the difference between Australia and the rest of the world. Bear in mind the RBA has a price target of 2 to 3%. That's a key difference here, 2 to 3% as opposed to 2. Consider also that inflation in Australia in the last quarter was running at about 6% on headline versus 8 to 9. So that's another key difference. And also consider how bad the RBA has been through the pandemic, Tom, as you sort out your bow tie.
That's a disgrace.
About forecasting some of this. Because the RBA back in the pandemic, Governor Lowe admitted this was a mistake. He basically said, you probably won't get a rate hike until 2024. And look at where we are now.
But that was all of the central banks. They've all gotten it completely wrong. The point that you made about 6% inflation, that is different than 10% inflation.
Absolutely.
That is different than 9% inflation. And when you're talking about that, you perhaps can push back, especially if the underlying drivers don't have the same kind of stickiness as in the United States.
And we're both on the same page on this. For the Federal Reserve, the overwhelming line of attack right now is to keep repeating the following line, which is, we are committed to not pulling back prematurely. Now, if the market conditions ease somewhat going into the next decision, doesn't that just make it easier to keep on hiking?
Right. Well, this is sort of the perverse consequence of the market not believing what the Fed is saying. Other people would argue that the Fed's tightening is affecting other areas other than just the stock market price just as much, if not more, in creating some sort of constriction in the economy. But either way, you're right. If the market doesn't buy what they're saying, it will force the Fed to more aggressively double down and actually complete what it is they're saying they're going to do.
Now, I get that goes against the theme of this morning, which is peak yields and Fed pivots, Tom, with the equity market up by 1.8%.
Yeah, I'm speechless here, John, because I'm waiting for the data, and all of this could change by Friday. But we have a June. Is it a June is busting out all over here in October? That's what it feels like.
The ISM was just a little hint.
That was a Broadway.
I'm letting it go. The ISM was a hint that maybe the data is softening just a little bit.
Or people want to see what they want to see in the data.
Isn't that always the case?
Yes, I mean, that's...
Using the RBA as an example as to why the Fed's going to pivot.
Exactly.
I mean, come on. Are we stretching?
I mean,
that's a question. Possibly. Futures up by 1.8% of the S&P. You going to sing us out?
June is busting
nice.
out all over.
All right. Okay.
Still has his hat.
Sure, everyone's going to stay tuned.
Talents of Tom Keene. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply at its meeting on Wednesday. The price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on headline reduction in output would not lead to a drop in actual barrels. New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at the level that would restrict economic growth. He said he expects real GDP to be at close to flat this year and grow modestly in 2023. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to Modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a first-hand look. Bloomberg's learned that iPhone exports from India went over the $1 billion mark in the 5 months since April. It's a sign that the country is making progress with its bid to become a force in electronics. India's on pace to double its output of iPhone over a year. Rising exports bode well for Prime Minister Narendra Modi's plan to make the country an alternative to China in manufacturing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Today's CFOs are reshaping the C-suite, breaking out of traditional roles to become Chief Future Officer. Global logistics is complex. It takes plenty of capital and plenty of focus. Deutsche Post DHL Group CFO Melanie Kreis makes sure her company has both.
My role is essentially saying what is working well in this company, where do we have challenges, and what should we do going forward.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Elevated inflation today is the most pressing issue facing monetary policymakers.
And by creating long-term upward price pressure then, secular shifts in supply chain management could present additional challenges for monetary policymakers during a period of already elevated inflation.
Raphael Bostic there, the Atlanta Fed president, live from New York City this morning. Good morning, a very good morning if you're along this equity market, because we have a squeeze, a bounce again, building on yesterday's gains on the S&P 500, pushing higher on the S&P by 1.8%. 1.8% higher on the S&P. Yields are lower by 6 or 7 basis points to 357.36. Off the back of that, this dollar's weaker, euro stronger, 98.97 on euro dollar, positive 0.7%. I blame Ed Yardeni for the last 24 hours, who came on this program yesterday and said the following: I think they have one more rate hike coming in November, and that will be it. He said that because the financial stability issue will pop up as a primary concern.
It is, and about every 7-8 years, there's the 3 books at the IMF, as I mentioned yesterday, and guess what? All of a sudden, suddenly, the Green Book matters. That's right where we are this time.
I'm not buying it. I have to be honest. I'm not buying it.
Bramo, that's why we love you.
Okay, thanks. No, hold on a second. I don't buy it because none of those financial stability concerns have actually bubbled over.
Sure,
we haven't
I'm with
seen
you.
them actually explode. So suddenly we're expecting there to be a response to something that is getting prevented from happening because people don't buy that they're going to actually push
And
things to
then
that extreme.
Making it more likely that it might happen.
Thank
because
you.
they're going to keep hiking.
That's the reason why I don't buy it.
There you go. You up to speed, Tom? That makes sense.
I think we brought the show to a dead silence.
I think a lot of people
Most people think that's a
I tell
constructive
you what,
thing.
Most people agree with you. If you ease financial conditions going into the next Fed decision, what do you think they're going to do? Makes it easier to hike rates again.
Exactly.
Doesn't
I'm just
it?
saying.
It is October, which means we must speak with Paul
Just gonna
Sankey,
ignore it.
founder and lead analyst at Sankey Research, who's ignoring this conversation. Paul Sankey has decades of experience in oil and knows in October there is Vienna, and there's also Park Lane, a string of hotels in London where the elite meet to greet in the oil community, as they do beginning today. It is the energy executive of the year is from Qatar. We'll pass on that, but far more CEOs together and the rest. Paul, is a consensus opinion that oil will rise back into the hundreds?
Yeah, I think so. I mean, the first consensus is that we'll get a 1 million barrel a day cut from OPEC tomorrow, and what people here are saying will be a brief meeting. I was told that the decision's already taken. I was actually hoping that they would take some time and argue a bit, so I'd get a chance to get out to Vienna towards the end of the week, but evidently the decision will come tomorrow. That should be, I think, a 1 million barrel a day cut. We've got about half of that probably Tom actually delivered, but it's still enough to tighten what's effectively a market imbalance in Q4. So any cut will effectively serve to raise prices.
The elite meet to greet at the Intercontinental Hotel or at the Dorchester with umbrellas in their drink, but is it just about Saudi Arabia and Russia?
Well, I have to say I've got to wear black tie tonight for the award dinner, Tom. I need your help with the bow tie there, but. Yeah, no, I mean, we had the CEO of Aramco talking very eloquently. Ben Van Beurden of Shell also very eloquent. We had protesters outside the Intercontinental yelling in my ear as I walked in. But the problem is the protesters don't really have a coherent solution. In fact, nobody does, and that's one of the issues. A couple of interesting points from Shell, for instance. He said that this quarter alone, China is adding more coal production than in the entirety of Shell's energy production. So essentially in one quarter, China grows coal by the entire size of Shell. And again, talking about the CEO of Aramco, again, talking about lack of spare capacity and how demand is remaining strong.
Well,
so again, further to your first question, it's all pointing towards higher prices, basically.
And that's really the crux of the matter. How much is this potential cut of 1 million barrels really an issue of a lack of capacity rather than the appearance of lack of demand? And how much pushback will OPEC Plus get from the United States, from Europe, saying, we need lower prices at this point to stave off a crisis? Why are you effectively causing an increase in prices or potentially laying the groundwork for that going forward?
Well, Lizzie, you made a great point, which I'll come back to. But firstly, yeah, I think the Saudis have enjoyed $100 oil and, would rather we were closer to 100 than to 80. So that's point one. Point two that you made is that they're so tight on spare capacity that they may well feel that, to rest their fields a bit, to give themselves some more breathing room, a cut is a good thing. The outside chance was that there'd be a major quota renegotiation, but it doesn't sound like that's happening. These guys are still using 2018 quotas, which are just completely nonsensical now in terms of things like Nigeria and Angola, just not even close to their quotas. but I don't think there's going to be that kind of agreement. I think it'll be a pretty strong cut decision led by Saudi, UAE.
15-minute meeting?
Of course, we've got the other interests. We've got Russia. 15
minutes or more for this meeting?
More than 15, I think. Those ones were just rubber stamps, but it may be. I think. Well, I was hoping it would take longer than a day and roll into Thursday, Friday. It sounds like we'll get a decision tomorrow, and before the markets in the US tomorrow. Yeah, could be.
There we go. Paul Sankey, thank you, sir. Good to see you. Paul Sankey there of Sankey Research. It's a turnaround, isn't it? Remember a number of months ago in the summer when President Biden went to see the Crown Prince of Saudi Arabia, Mohammed bin Salman. There was a fist bump. It was like that, TK. Like that. Nice. There was a fist bump. There was a hope. Come on, Bramo. Don't sit it out. There we go. Nice. Bump. There was a fist bump and there was a hope. There was a hope that maybe they would loosen things up, and now they're talking about a big cut.
Do you feel like that those fist bumps were just as awkward as President Biden's?
I don't think anything comes close to how awkward that fist bump was in Riyadh.
Okay, so that's good. That sets the bar low enough for us to succeed it.
That's why we did it.
But I do think it's going to become a political, real big issue, especially as we've seen a plateauing in gasoline prices. They basically bottomed out and how much they're going to come down. And this has been a huge political issue heading into the midterms at a time when this has been the one thing going for the inflation year-over-year inputs for the United States.
I'm looking at a technical chart, John, too fancy for TV, and the answer is resistance rather for Brent crude is $98 a barrel, so we're $10 away from where I begin to get excited about a trend change.
Potentially, Tom, going into a global recession, you can see why OPEC Plus is having this conversation. It does make sense, does it not? Yes. The other thing that Paul Sankey said that stands out for me, coal in China. I mean, this is problematic, isn't it?
Yeah. Talk about from a green energy standpoint, from this question of how much pollution is going to be put in. If they're supplementing the equivalent of, what did he say, Exxon's total? Shell's total output with coal.
In a single quarter.
In a single quarter. It really speaks to, on one hand, potentially they're generating more economic activity, which could speak to also demand not exactly slowing as much as it might be. Again, this goes to the point that Paul Sankey was saying, that perhaps a 1 million barrel cut is more an issue of a lack of capacity from some of these nations than really reflecting a cooling in demand as they perceive right now in the market.
You got a sense of that worry through the summer.
100%.
I think we got a really big sense of that, Tom, the concern from people in this oil market about the lack of spare capacity, that these guys in many places were at maximum.
And the Marshallian cross, on radio it's tough to do it, but I got my fingers crossed. The petrol Marshallian cross is much, much, much more sensitive than we perceive.
Translate that, TK.
The two lines crossing are really, really hypersensitive, where one little thing moves and the equilibrium gets out of point. And in this case, there's a constraint in Saudi Arabia, so that moves that price higher. Am I doing okay here?
That was beautiful. That was beautiful. That worked wonders. I think it really worked out. That was an intriguing segment, wasn't it?
Yeah, well, I got an umbrella in the tank, so it's good.
Someone asks, what's going on with oil?
That. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
The big issue here is, does the Fed get the kind of controlled moderation in labor markets and growth?
We just haven't seen that rise in the unemployment just yet.
We are starting to see some companies rip off the earnings Band-Aid.
Markups are insanely high everywhere. People have been gouging prices for any goods.
I think what's breaking is the soaring dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Peak everything and a sprinkle of capitulation. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures positive. TK, a bit of capitulation out there across Wall Street.
A bit of June, the capitulations there we cover. I don't know what the shorts are doing on the short cover, but what is happening is we're all looking to Australia first to blink.
First to blink. Are you calling that a blink still?
Yes. Oh, come on.
25 instead of 50. That's a blink.
They went 25, and you saw it in Aussie Kiwi, and you saw that's the currency pair.
Thank you for that. I appreciate that, yeah.
I didn't know New Zealand is to the east of Australia. I thought it was way over to the west.
You got out the map.
That's how dumb I am.
Okay.
Anyways, I think Australia is the first to blink. Will we see more of that given the data that's coming in?
It plays into the theme of the moment, Lisa. Yields lower, yields lower.
I don't know if I would agree that they blinked. They perhaps ratcheted back the pace. And that, I think, is actually one heated debate among Fed officials, as according to Bloomberg reporting, that it's not so much the destination that's the big question at this point. It's the pace at which they will raise rates. Do they want to front load it, and are they willing to experience some sort of breakage akin to the financial stability risks that Ed Yardeni was speaking? Are we seeing perhaps not a blinking, but perhaps a retracement in the pace of how much and how quickly some of these central banks are going to raise rates?
We talked about the step down through the whole of the summer, from 75 for 50 to 25 for the Federal Reserve. Doesn't this rally just make it more likely they go 75?
Right. I mean, this is sort of the perverse element of the whole thing, is that the more the markets get comfortable, the more the Fed is going to have to be that much more aggressive and end the party.
Do you want to do a bit on capitulation? Seen, the big bull at JP Morgan, Marko Kolanovic, comes out with a note last week, adds to it yesterday, says the following: our 22 price targets are at risk. That's one. So that's the big bull on Wall Street. I would say there's a bit of capitulation in the mix there, even though he's not admitting
from others,
it.
Okay. From others.
You want to do the others? Ray Dalio of Bridgewater. When the facts change, I change my mind. This is what he had to say. I no longer think cash is trash. Lisa, your take on that?
It's, he was talking about adjusting to the facts, which have changed, and basically he's getting on board with a trade that's already gained a lot of steam, right? I mean, if you think about it, I was looking, for example, at this ETF of T-bills that has seen more than $10 billion of inflows so far this year. People have been flooding to cash, and finally he's saying, okay, hold on a second, actually, it's not terrible.
Tom, Ray Dalio, do you remember when he said cash was trash? Davos.
Yeah,
Those
I
years
remember.
ago.
My problem with this with triple leveraged all cash is I'm doing 2 and 20 on triple leverage.
You've done great this year. Big
It's
inflows.
working out great, but at some point it ends. What I'm going to suggest is when the facts change, which is why we need to focus on the facts along with the well-intentioned punditry that we listen to every day. The data to me matters, and I'm sorry, I'm going to payrolls with a 3-month moving average. I can't remember the number, 268,000. That's not Powell friendly.
The mantra, don't fight the Fed, is now in reverse. And the Fed keeps saying, we're not going to blink, we're not going to retrace. That's what caused Ray Dalio to move away. That's what caused Marco Kalanovic to get very annoyed at the Federal Reserve because they weren't cooperating with his thesis.
He sounded annoyed, didn't he?
He did.
Just a little bit, or maybe a lot.
Yeah, he was saying they're going to do policy error.
The line of the Fed speak at the moment is we are committed to not prematurely loosening policy. That's what you heard from Vice Chair Brainerd earlier this week. Futures right now, they are positive in a big way. They add to the gains of yesterday. Let's whip through the price action for you on the S&P 500. Equities up by 1.6%. Equities up by 60 points on the S&P. Yields are lower by 5 basis points to 358.94. Your 10-year yesterday was down 17 basis points, 17 or 18 basis points. Your 2-year was down that much as well. So we are well off the highs.
4% a cup of coffee
last
ago.
week. Last Wednesday, Tom, 4%, north of that level. Right now, your 10-year, 358.74. Off the back of that, TK, some dollar weakness, euro strength.
This is curve moving, not elastic. 210 spread is pretty much unched all in all.
Whole thing just shifting lower.
Shifting, that's
curve
the
just
right
a little
word.
bit steeper by a couple of basis points today, but really the whole curve just shifting lower. Euro dollar, Lisa, 98.97, positive 0.7%.
Yeah, but still hovering below parity as we look at dollar dominance, and perhaps it's not going to change that much. We get a slew of Fed speakers today. Lori Logan of the Dallas Fed, John Williams, Loretta Mester, Mary Daly, line them all up. They're all speaking today. Perhaps they will all repeat what we heard from John Williams yesterday, which is they are committed to continuing with these rate hikes. So don't fight the Fed. Is this belief in a pivot that the market seems to be buying perhaps premature if the Fed is saying don't do it? And yesterday, just to give you a sense, we saw the biggest one-day drop in 10-year real yields going back to March of 2020 as people start to believe in this idea of a pivot. At 10 a.m. we get the JOLTS data in order for job openings in August to give some semblance of where we are in the labor market. In the July reading, this to me shocked me. We actually saw an increase in job openings. How much are we actually seeing the labor market cooperate with what the Fed has been really saying they want to be seeing? And how much, and John, you've been really talking about this, are we looking at a lagging indicator in order to dictate future policy, and it sort of creates this real dissonance for the Federal Reserve and frankly for markets trying to get their heads around it. And at 11 a.m. we hear from ECB President Christine Lagarde. She is in Cyprus speaking with the ECB president of that particular bank at a time when you're seeing the same pivot discussion happening in Europe. It is slightly different as you see yields come in pretty dramatically yesterday and again today. John, it is different because there is this belief, as we were hearing from Freya Beamish earlier, that they will engage in some sort of quantitative easing to buy bonds, to suppress peripheral yields, to control the pace of increases in order to control financial stability.
And keep on hiking simultaneously.
Yes.
Unreal. Lisa, thank you. That's your day ahead. Let's get to Amy Wu Silverman, the equity derivative strategist at RBC Capital Markets. Amy, wonderful to have you with us on the program. Your words, a shoe and a half has dropped. What do you mean by that?
Well, look, I think the question of the day has been, where we are in terms of capitulation in the volatility markets. That's certainly been, the question. And we've had kind of a regime change, right? And we've kind of had a reprieve now, but we had been watching since August, John, for a pickup in volatility for September. I think we've certainly got it. We have VIX up 22%. That's the third highest on record this past decade. I actually do think there's more to go. So I guess a shoe and a half instead of the full 2 shoes.
Amy, I look at where we are through a fractious third quarter, and I've got a gauge in the fourth quarter. Do the cross moments work right now from variance on out to kurtosis and skew? Do the cross moments work? The derivative mathematics, does it work now, or is it less useful?
Yeah, it's been an interesting narrative, Tom, because with the skew, the kurtosis, the tails, these are all the metrics we look at in options. And the narrative has been that it's been quite broken this entire year. I don't really know that has shifted too much. If you look to historical skew levels and tails, they're all still quite low. And I think you have to kind of bear in mind that when you're an overall higher volatility regime, these numbers seem on a relative basis lower, but the reality is we're just at such nosebleed levels, right? So the math kind of doesn't work in your favor from that perspective, but it certainly doesn't mean that people are not buying tails. We are seeing it even with the reprieve we're getting in the market right now.
Amy, you said that September will go down as the third most volatile month in the past decade. And some people looked at this and said, okay, now we're worried about financial stability risks and it's going to cause central banks to pull back from some of their rate hiking plans. How much are you seeing this in the opposite way? That basically the stress tested a market that is seeing liquidity withdrawn, and that it passed, that we didn't see anything break. So it actually gives Fed officials conviction to keep going.
Yeah, it's interesting. And, let's say that is true, Lisa, that could thereby, keep them on their path, which would actually generate more volatility. So it's this interesting cycle that we're seeing. I think that, historically, when you look to October actually tends to be the most volatile month kind of across the past decade. And that's even with the bump that we got in September. I think that especially with a critical earnings season, that's going to continue. Again, I think this reprieve is sort of the fact that we've gone through a big quarterly expiry. We sort of have this kind of no man's land of idiosyncratic data for the next 2 weeks, but then, we're going to be back in the hopper again. And so I would say that, don't count volatility out now, even though we're kind of dropping back to 20 handle levels.
Amy, it's one of those days, isn't it? Because the equity market's up. We'll be talking about peak Fed, peak yields, peak dollar, peak volatility. Amy, a feature of your research through much of the summer, much of this year, is just how much we're going to shift towards a higher volatility regime for longer. Amy, can we just end on that? Have clients got on board with your view of thinking beyond, say, the next quarter, into next year, and perhaps longer than that?
Yeah, I think so. And I think it has to do with the fact that when you shift to a different rate regime, it is, by its nature, something that has to shift along with it. But one thing I will tell you that clients are looking at is, you were talking about how cash is not trash any longer. The other thing that's happening is yields are incredibly attractive. So, you have a stock like Apple, let's say, which really is only down 2%, but it's been a very bumpy ride. And so the volatility on that has more than doubled. That's essentially how much yield you're collecting on something like that now. And so even with a higher volatility regime, people are looking at higher volatility harvesting on kind of attractive names of high quality.
Amy Wolf-Silverman. Amy, thank you, of RBC Capital Markets.
Volatility harvesting.
You like that?
That is so Wall Street.
It's incredibly Wall Street.
It's like picking apples or something. The autumnal glow, John, of going north up the Hudson
Are you
River
still dreaming about
and apple picking?
An apple picking.
Let's go up in volatility. Let's harvest some volatility.
Would you like to take a derivatives expert?
Folks, what she's talking about there is pulling in premium and harvesting the price of hedging and bringing it into you.
Volatility, higher vol for longer is the point that Amy's making here, Tom. And I think that resonates with a lot of people.
Yes.
I wonder also, if we can just pause for a moment, because on days like today, we will be talking about peak yields, peak Fed, peak dollar, peak vol, all of the above. What if this is it, that we just kind of hang out at 4% on a risk-free rate, 3.5 to 4%?
Yes.
How much does that change the market from where we were through much of the last 10 years?
Especially with borrowing costs, you haven't seen companies actually have to re-engage with the market at these levels. When they do, suddenly their entire model starts to change.
Futures up by 1.7% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and see gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month, but now Bloomberg's learned Kwarteng will announce it sooner. He's been under pressure since tax cuts he announced on September 23rd led to a sell-off in UK assets. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea fired a missile that flew over Japan, and that prompted a rare public safety warning from Tokyo. The missile splashed down in the Western Pacific, about 2,000 miles east of Japan. Bloomberg's learned that the Biden administration will announce new restrictions on China's access to U.S. semiconductor technology. That's an escalation of Washington's efforts to stifle Beijing's industrial ambitions. It could also hurt growth in the $550 billion sector. And former Meta Platforms Chief Operating Officer Sheryl Sandberg is donating $3 million to the ACLU for the fight for abortion rights. The organization says Sandberg's donation will give it a running start against state anti-abortion efforts spurred by the Supreme Court's overturning of Roe versus Wade. Bloomberg estimates Sandberg is worth $2.1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Of course, we are facing difficult times. We have an unprecedented level of inflation since the creation of euro. The key point is to stand united, and that's why I really think that there is a need for a global action plan at the European level against inflation.
Bruno Le Maire there, the French finance minister, sitting down with the brilliant Bloomberg's Maria Tadeo, live from New York City this morning. Good morning. We'll catch up with Maria in just a moment. Allow me to whip through the price action for you on the S&P 500 and beyond. We build on the gains of yesterday with a move higher of 1.6% on the S&P. Equities up by 59 points. Yields lower by 4 or 5 basis points to 359. Yields down, stocks up, dollar weaker. Euro dollar 98.83, euro dollar positive 0.6%. Ray Dalio of Bridgewater says cash is no longer trash. Connor Sen of Bloomberg Opinion out on Twitter this morning responding to some of that perhaps. Strange to wait until a 60-40 is down 20% plus on the year to say cash is no longer trash. Would have been a good flip 10 months ago.
It's what it is. Everybody's adjusting, John. I don't know what else. We're going to see more like Ray Dalio, readjusting
We've
here.
seen a little bit of it.
The bull at J.P. Morgan, readjusting.
It took a while, didn't it? It took 10 months.
You wonder if this is almost like the 1231 readjustment, 3 months early.
3 months early.
I would wait for the data. I would wait for the data, and I can't remember who it was who said this Friday's jobs report really sets you up for the November Fed meeting. We will have to see on that. Futures up 61. Maria Tadeo in Luxembourg on the events here. I've got 5 ways to go, Maria, and I'm going to go to a headline from the Kremlin of an hour ago, I guess. They say 200,000 mobilized. Translate mobilized, Maria, if you can.
Well, Tom, first of all, I'm not even sure that number is accurate because at this point we've heard so much from the Russians and then in real time they do the complete opposite. And some of the evidence that we have is that it has been very difficult to bring men to the front. There has been questions about the kind of training that they have. They're facing a professionally trained army like the Ukrainian army is, the kind of equipment that they have and the kind of conditions that they operate in. So a lot of this, I would be very cautious, and it's always difficult to tell with the Russians what's spin, what's propaganda, and the actual reality on the ground. And the reality is, on the battlefield, the Ukrainians are making headways.
And among others, John, James Stavridis, the Admiral, Supreme Allied Commander, he's hugely suspect that they can, quote-unquote, mobilize 200,000.
This is the tension on the ground. We need to talk about the tension within Europe as well. Maria, talk to us about the tension between the German government right now and that package they announced in the last week to how people experiencing high energy prices and what the rest of the Europeans are saying about it.
Oh la la, this is a heated one, and it really is behind the scenes. Now, a number of things. You have to go back in time for the past 7 days. We had the Nord Stream explosion, then immediately after, the Germans came out with a mega package. 200 billion euros is a political message to tell Russia, okay, we have a response, we can deal with this, and we're willing now to spend. Do not mess with Germany. The problem is that this has repercussions on everyone else. Not everyone has the fiscal capacity that Germany has. And today we've seen the reaction. A number of countries saying that they worry that this is going to create fragmentation in the euro area. They also worry, by the way, behind the scenes about the lack of communication and clarity. They were taken aback by this mega package. They were not expecting it. And then, of course, I also spoke with the French finance minister who said at this point it should be clear to everyone that the only way to deal with this crisis is on a European level. This is not every man to himself. It has to be done jointly and in coordination with all member states.
Maria, what's the German response to that?
Well, you know, it's going to come handy, but this morning I happened to bump into Christian Lindner. I put that question to him, and he said there has been some miscommunication, perhaps a misunderstanding of what the Germany or the German plan wants to do. He says overall 200 billion euros looks enormous, but the size of the German economy would fit in that. And he also says we're responding to the size of the problem, which for Germany, it's also enormous. He says we're not the only country to come up with domestic measures. Other countries are doing that. It's just the size that changes, but sometimes size does matter in life. And here, it has created political tensions behind the scenes. There's no question about it.
Keep it together, Lisa. It's not funny.
Maria.
All right, stop it.
Never
Maria,
change.
thank you. Maria Tadeo of Bloomberg, thank you very much. I'm not going there. I'm going straight to a note from Citi and Andrew Hollenhorst.
I saw that.
Who says the following. We continue to see fundamental economic risks as balanced toward higher rates and lower risk asset prices. Tom's going to love this. Friday's jobs report is growing in importance. A softer reading would continue the, quote, bad news is good news for equities narrative and vice versa.
I have nothing.
You've got nothing to offer.
I have nothing to offer on good news is bad news is bad news. The nodes of good news and bad news.
Veronica Clark of Citi is going to join us a little bit later so we can explore this note a little bit further.
And let's just be clear, they're only nodes of bad news. Otherwise, it's shoots
over
of
there
good
on
news.
that
Let's
side
just
of
be
the
real
desk, that's
honest.
true.
But the other point that they're making here, Hollenhorst's team, is that right now, still, the economic risks are tilted to higher rates and lower risk asset prices, right? They're not necessarily seeing the groundwork, and certainly we're not seeing that with the initial jobless claims, that the labor market is really loosening enough to really give the Fed pause. And we heard from JP Morgan's Bruce Kasman yesterday that it would take 3 consecutive months of 100,000 jobs being created, which is incredibly low, in order for the Fed to really second-guess their moves.
Standout conversation of the last week or so, for me at least, was Tom Porcelli of RBC, who basically said it's going to take a lot of work to get this labour market to crack. And the line that I've heard from several people over the last couple of weeks is that you can't fire what you couldn't hire. We've experienced 2 years of corporations trying to get lots of people onto the payroll. They can't find them. Job openings are sky high. So if you're looking for the labour market to crack, what's going to crack? They couldn't hire the people. That's why we're hearing so much of the word hiring freezes, not layoffs.
Yeah, I think Lisa mentioned it earlier in her brief. I was making some fresh tang, but JOLTS, I mean, I'm sorry, the JOLTS survey is a signal of that.
And at this point, though, and this was sort of the tension in Tom Porcelli's point, if you have high inflation and you don't have a labor market that's showing signs of great weakness, how do you know you're making progress towards your ultimate goal? And it really puts the Fed in a bind. So even if he's right that that's a lagging indicator that's not going to crack, then the risks are even greater that the Fed's going to over-tighten and create a real downturn in order to achieve lower inflation.
Let's put the two things together. Peak Fed with claims sub 200K. Does that add up?
Well, I mean, if you say that there has been a structural fundamental change in the labor market, maybe you can make that argument, but the Fed's not making that argument.
Tom Titsura is going to join us soon, the head of fixed income research at Strategas, which I'm told is a bad company. They like that. Strategas, a bad company.
Yes.
Why not just bad? Anyway, futures up by 1.5% on the S&P 500 from New York City. This is Bloomberg.
you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point